So my judgment about what to do at different points would be quite different. But I think from 2007 and 8 to the decade that's happened, I've had very strong views about when policy should be quite aggressive. This is one of those moments, and to be totally candid, I've had very public views, but when policy needs to sit back, I see a lot of policymakers that look to me like they're oversteering, raising rates one month and then cutting them the next. It's just not my view of how monetary policy should work. But when you're going down a road like this and the steering wheel's in front of you, and you see a big 18-wheeler coming after you, this is a time where you shouldn't be hesitant.
Trading slightly stronger.
Kevin is our guest host. He's going to be with us for the rest of the program, and we do have a lot more to discuss with him. Thanks, Kevin.
Okay, coming up on Squawk Box this morning, some stocks to watch. We'll head to a break. Take a look back at similar four-day routes in the Dow, and what they show, they're usually tied to an event. Take a look at this. In 1998, it was the collapse of the massive hedge fund long-term capital and the rushing financial crisis. In that case, the Dow lost 1,063 points, or 12%. And in 2001, the September 11th attacks resulted in a 1,200-point drop, also a 12% drop. And then in 2008, the financial crisis led to a four-day decline in the Dow of more than 2,800 points. Resulted in a 1,200-point drop, also a 12% drop. And then in 2008,
This is your chance to settle your debt for a fraction of what you owe. We even offer a guarantee, so there's no risk to call. Unlock the secrets credit card companies don't want you to know. Within 5 minutes, we'll show you how our program works and how much money you can save. Credit Answers, your answer to overwhelming credit card debt. Call 1-800-388-1267. 1-800-388-1267.
welcome back to Squawk Box this morning. Take a look at futures.
Call 1-800-388-1267.
Switching it on the typical wonderful. Thank you, bro. Thank you so much. Abhishek Nari, thank you so much. GD for Grand Theft Auto 5. तेरी को क्या पता है मेरी जीएफ है या नहीं, और हो तो तेरे भी नहीं. हाँ अब अभी तो मिठा है, मेरे को पता है. एक गर्लफ्रेंड नहीं पटा पाया.
So my judgment about what to do at different points would be quite different. But I think from 2007 and 8 to the decade that's happened, I've had very strong views about when policy should be quite aggressive. This is one of those moments, and to be totally candid, I've had very public views, but when policy needs to sit back, I I see a lot of policymakers that look to me like they're oversteering, raising rates one month and then cutting them the next. It's just not my view of how monetary policy should work. But when you're going down a road like this and the steering wheel's in front of you, and you see a big 18-wheeler coming after you, this is a time where you shouldn't be hesitant.
Trading slightly stronger.
Kevin is our guest host. He's going to be with us for the
down. And what they show, they're usually tied to an event. Take a look at this. In 1998, it was the collapse of the massive hedge fund long-term capital and the Russian financial crisis. In that case, the Dow lost 1,063 points or 12%. And in 2001, the September 11th attacks resulted in a 12-month.
So my judgment about what to do at different points would be quite different. But I think from 2007 and 8 to the decade that's happened, I've had very strong views about when policy should be quite aggressive. This is one of those moments, and to be totally candid, I've had very public views, but when policy needs to sit back, I see a lot of policymakers that look to me like they're oversteering, raising rates one month and then cutting them the next. It's just not my view.
True heroes make it all look so effortless, like your Hotpoint multi-flow oven from Curry's PC World. It cooks the perfect roast chicken thanks to the evenly distributed heat and keeps your oven spotless. All the grease is removed by catalytic liners, so you can spend more time cooking and less time cleaning. Plus, you'll even get a 1 in 10 chance of winning £500 when you buy any Hotpoint Easy Clean oven. Heroes of the home at Curry's PC World. Terms and register at curryswin500.co.uk.
Of time where you were at a certain place or in a certain regime,
But when the
that
facts
would be
change, sir.
preferable. So I think that he would change in this regard. I think they're monitoring it, and I think they're waiting for the moment. And that moment may be one where they've done it in coordination, and I think you've been involved in that, Kevin. It takes some time to put everybody together, with a big question about whether Europe, this is not 2008 in the sense that Europe or at least Europe then had a positive rate to cut.
Right. So it's different, but these big institutions have muscle memory working together. The ECB staff and the Fed staff, who are both absolutely first rate, they have to have been in discussions over the course of the last week, sharing information. That's a deep relationship. And once you get to a weekend, it is not difficult for them to find common language in which others could sign up to about what each of them could do to support their economies. Of course, as you suggest, having negative rates already in Europe makes it such that it's more difficult to find ways to stimulate the economy. But I don't think it's more difficult to buy some time. Christine Lagarde is a fabulous leader. I knew her well in her old jobs. And while they're in the middle of a comprehensive review, as Becky suggested, the facts on the ground are changing quite quickly.
Steve, yeah. Hold on. So I've mentioned you because you rhetorically continue to ask all week long the question of why would a quarter point, what does that have to do with stopping a pandemic? Kevin made his case. I don't know whether you were able to listen to all of that or where were you for the last half hour. So his point is that if central bankers all talk this weekend, come up with a concerted response, that it buys some time and it's a détente to just maybe put things on hold for a while to see exactly how this plays out. So that's your answer on what a quarter point would do. Would you like to push back on him that it actually wouldn't help?
Joe, put it this way. I'm more skeptical about the effectiveness of this rate cut than I have been about others. And the reason is because I think about what level of interest rate would cause me to want to go to a concert and possibly get coronavirus. The demand that would be stimulated from that. Now, I think I get everything Kevin's talking about, which is the confidence effect, and and the idea that, well, somebody is on this. And I was just going to sort of throw it back at you. Is a statement enough, or do they need to act? Came out with a global statement that said, we're monitoring this, we will act if necessary. Is that enough, or do they actually need to do it now?
So two things. First, you said you were skeptical of the benefits of this rate cut, and that skepticism is rightly held. But I think there's a better case for this rate cut than there certainly were in the 3 rate cuts last year. Stock markets were moving higher, animal spirits were moving higher. So there is a better case, it strikes me today, than on any rate cut in this regime since I left the Fed in 2011. What needs to be done this weekend? This is both substance and, to use language that Secretary Geithner used to use, there's a little theater to this too. It has to be backed up by substance. I would prefer that the world central banks make a joint statement and the Fed adds a quarter. The Fed takes 25 basis points off to show this isn't empty rhetoric. But again, I think moving together, having a coordinated statement is what is necessary. And if it doesn't happen this weekend, my judgment is it will happen.
I just want to throw it back at Joe. You're the one that asked the question, I think, earlier in the first hour, Joe, what if it doesn't work? That is a problem for Powell. When you shoot, you want to hit.
I don't expect it to be a panacea, as we said. But every time the Fed cuts, we ask that question.
Right.
What if it doesn't work, and what do they know that we don't know? So,
Steve, the only other thing I'd suggest is they need to be working on Plan A, Plan B, and Plan C. Right. And so as you're moving on this, the other discussion that needs to begin in Washington, if it hasn't already, is a fiscal response. The administration, the Federal Reserve, key leaders in Congress, it is not too early to start to speculate about what could be done. We don't want to get in front of the facts on the ground, but you need to use moments of time when you get them to build out those plans instead of sitting on your hands.
There's two arguments, I think. The first is everything that Kevin said. The other one is that you have the supply problem in China. That doesn't bring any supply over. You have a decline in demand. And what you were talking about earlier, Kevin, is, well, you would get people to make investments. Should they be making those investments if demand has actually declined? The other argument on the other side is this. Since you've had this decline in investment, you've had a decline in the neutral rate. And that means the Fed is too tight. So the Fed is literally behind the curve here, right? If you look at the 3-month to 10-year, those are reasons that I think speak to what Joe's talking about and what you're talking about, which is that, and I think Mark Grant said this morning, even if the Fed cut twice, they would still be below the 2-year. Right?
Yeah, I mean, the business here shouldn't be chasing markets, but it should be listening to markets. And markets are sending a signal about the real economy. When 10-year Treasury yields are materially lower than they were in the darkest days of 2008, when they're materially lower than they were in 2012, they might be wrong, but I'm willing to give them the benefit of the doubt and act now because the risk-reward strikes me as quite compelling.
I feel like I'm convinced here.
Yeah, I have to say, when I listened to him at the top of the hour talking about his reasons why, explaining how, and the idea that you would take those cuts back quickly, you would take the insurance back quickly if this clears up rapidly. So not locking yourself into some situation like this.
Right. The purpose of insurance is to, as they've taught us over the last couple of years, is we were buying insurance against China-U.S. trade war. We're buying insurance about a Brexit unwind.
I guess the only question I have
they never took it back.
The idea of the CEO who's sitting there thinking, okay, I can either postpone my factory installation a month, or I can just postpone it for a year. That don't you think that you think that they why would you without intervention push it out a year completely? Why wouldn't you just wait a month or two?
So
you see what I'm saying?
I see what you're saying, but we are not in the world of perfect.
Right.
We are not in the world of how do we take this economy and have it turn back on a dime and reaccelerate.
Right.
But we are in a world, Andrew, in the United States where the initial conditions have been quite strong.
Right.
We came into 2020 with labor markets the strongest they've been in 50 years, business and investment that had slowed considerably over the last 18 months. But if you listen to executives like I do, and I'm sure you do, 2020 was an opportunity where they could invest.
Right.
I don't think they're thrown in the towel yet, but if we waited 6 or 8 weeks, I think they'd throw in the towel on 2020 investment.
They were ready to invest because of the China trade deal being kind of tempered at this point. We're not looking at big tensions between them, but this has put everything on hold.
They saw a tariff truce that would at least last till the first Tuesday in November, and they wanted to see what could be done there. Because the U.S. economy is strong enough, but this gives them an additional reason to sit on their hands.
I'm just going to make a practical suggestion here, and I'm going to use the Olympics as an example, okay? So the Olympic Committee has till April of basically the last week of April to make a decision about what to do this year with the Olympics. But then there's a secondary issue, which is when would you actually, if you were going to delay the Olympics, when do you do it? Do you do it in this calendar year? Do you push it out a year? There's lots of factors about when you would do it that have nothing to do with the actual economics of it. And so I think people would do as much as they can do as quickly as they can do it. But I think it actually probably has to do with the practical concerns of timing and everything else, as opposed necessarily to whether the Fed's going to step in. I'm just positing an idea here.
So I haven't convinced you, but I'm convinced.
You're convincing Becky and Steve and Joe.
I think you guys had a great conversation earlier, which is what would it take? And to me, and maybe it's just me, it's data. And I think the absence of, we're still having this conversation about what is the morbidity rate? What is the infection rate? What are all these things? How does this compare to the flu?
The biggest thing, I think, is the idea that the CDC has to get those tests out there.
They have to get the tests out.
If you have 840,000 people, if you have 8,400 people that you are monitoring in California who have symptoms, but you can't say, no, it's just the regular flu or it's just something else, if you can't test them and run through those issues.
The human race has learned to live with disease and infectious disease. Yeah. Somehow we prospered to it, to overpopulate the land with 9 billion people on it. The markets have prospered amid these infectious diseases.
And I think we're overpopulated.
Well, we'll see.
Well, maybe you want to do a one-child. You probably do. Do a one-child law.
It was not the substance of what I meant to say, Joe. I'm sorry if I distracted you with that comment.
I've seen every. Malthus has lost every argument.
He has. Ever. I mean more from an environmental standpoint and the advent of the Anthropocene.
Okay. Well, if you take that tech, I mean, we're all going to be dead anyway from climate change. So why even worry about coronavirus then, right, Steve?
Joe, I was trying to make a positive point here.
All right.
That we have in fact lived through this, and I think people need the data. And they need the language and
I think we could see some positives emerge from China too, if they really do manage to get. And I don't know how we know whether we would know whether they get a handle on it. But it seems that the cases are slowing in terms of how many are added per day. And if China is able to keep it at 100,000 in a population of 1.4 billion people, this is not the epicenter in the United States. Maybe we can try to.
My hope is actually on Italy, which is, I mean, it's a Western country that will impose, I believe, kind of transparent and scientific rigor over what's happened in Italy. Mm-hmm. And when we get that data, I think it will give us something here to say, okay, if it comes here, here's what we can expect. And I think the absence of that has been part of what's been behind the trade here, which is that there's just no way to even compare this to other things.
I suspect Steve is right that if the data were obvious, the Fed's move would be obvious. Right. My judgment is if the Fed waits for the data to be definitive, there will be more suffering than is necessary. Central banks get paid to make tough decisions with imperfect information. This is one of those times.
They don't get paid a lot.
They don't get paid much.
That's why he's not going back.
We've got a lot more coming up on Squawk Box.
The blame that you take relative to the salary that you make, the ratio is all out of whack on that.
That's why we've got to unite around the chairman now, because this is a time of testing.
When we return, a continuation of this conversation and so much more. New Zealand and Nigeria reporting its first cases of the coronavirus, and Moody's Analytics now saying the odds of a pandemic have doubled to 40%. We're going to speak to a doctor right after the break on what you need to know about the virus outbreak. Plus, much more from former Fed Governor Kevin Warsh. The futures at this hour. You know, on a percentage basis, this isn't the end of the world right now, but Dow looks like
it looks much better than it did earlier.
Yeah, much
we got to watch the 10-year.
Would be earlier.
I always point out it was Moody's Analytics, not Moody's. So
we're going to be right back. And a reminder, of course, you can always watch us live, especially right now. Live on the go matters more than ever. If you have to head to the office, get on the CNBC app. We're going to be right back in just a moment.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app to see the latest editions under the Your New Episode section. Happy listening.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
To as high as 8.5 to 8.75% at Ameritrade or E-Trade. Move your account to Interactive Brokers and save at least $4,700 or much more if you're trading big bucks.
Guys, if you wake up feeling fat, bad back, heartburn, tired, then it's time to get healthy and lose weight with Nutrisystem for Men.
I'm healthier, I'm stronger.
Lose up to 13 pounds and 7 inches overall in your first month. Money back guaranteed. Order now and we'll rush you Nutrisystem for Men.
Not only did I lose 60 pounds, I don't snore.
Act now. Buy 1 month, get 1 free.
Go online or call 877-344-FIT5 right now. Buy 1 month, get 1 free.
A hard 20 after a hard day isn't for everyone. Waking up before the sun isn't for everyone. But at $58 a month, Peloton is for anyone who wants it.
At today's Best Western, stay 2 nights and get a free night for your next stay. 1 night, 2 nights, free night. Book now at bestwestern.com.
Is killing us.
So what's your ask? $110,000.
$285.
$2 million.
Could I bail them out? Yes.
You have helped me save this.
It's spectacular.
The Deed season premiere, Wednesday, 10 p.m. Eastern. CNBC, get yours.
And when we return, more from former Fed Governor Kevin Warsh, and take a look at the 10-year note at this hour. Higher yields might help. And we're at about 121. We were as low as 117. So cooperating, and the futures aren't quite as bad as we have seen. Not the worst levels, but it's a pre-market session. We know what can happen between now and 4 p.m. Basically anything, but we're down about 300. We're coming right back.
Don't forget to subscribe to our podcast. You'll get interviews, original content, and behind-the-scenes access. Look for us on Apple Podcasts or on your favorite podcast app. And subscribe to Squawk Pod today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow at TuneIn and always be in the know.
Score free Wi-Fi. Can it help us win? Hey. We're all winners with the Hilton Prize Match Guarantee, all right? Man, you guys are adorable. All right, let's go lose this soccer game. Come on. Book with the Hilton app. If you find a lower rate, we match it and give you 25% off that stay. Expect better. Expect Hilton.
At Ameriprise, our financial advisors can not only recognize you in a crowd, but recognize what's important to you in terms of your goals. Get one-to-one goal-based advice where and when you want and real-time goal tracking online. Ameriprise Financial.
The S&P 500, the benchmark for most U.S. equity investors. Only Sector SPDR ETFs can divide the S&P 500 into 11 investable pieces. This allows you to underweight and also overweight sectors to best meet your clients' objectives. Sector Spiders, write your next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully.
Expedia. Once upon a time, being middle class meant you could afford to live a comfortable lifestyle. But these days, it often means being up to your ears in credit card debt. If you owe $10,000 or more in credit card debt, here's something that might surprise you. There are secrets that credit card companies don't want you to know. Secrets on how to completely resolve your debt and become debt-free. Imagine the thousands you could save. To unlock these secrets, request free information from Credit Answers. Just call 1-800-388-1267. We're not talking bankruptcy or debt consolidation. This is your chance to settle your debt for a fraction of what you owe. We even offer a guarantee, so there's no risk to call. Unlock the secrets credit card companies don't want you to know. Within 5 minutes, we'll show you how our program works and how much money you could save. Credit Answers, your answer to overwhelming credit card debt. Call 1-800-388-1267. 1-800-388-1267.
Welcome back to Squawk Box. America's scrambling to address the mounting coronavirus outbreak. Meanwhile, in China, the death toll there has now climbed to over 2,700. Meg Terrell joins us with an update on the outbreak and what's happening in the medical community. Meg.
Good morning, Andrew. With case counts now topping 83,700 worldwide and more than 2,850 people dead, the World Health Organization saying the virus has pandemic potential. It continues its march to more countries and regions of the globe, with the first case now reported in sub-Saharan Africa, an Italian citizen, in Nigeria. The world is reacting. Switzerland banning gatherings of more than 1,000 people, including next week's Geneva Car Show. And our Wilfred Frost confirms this morning that J.P. Morgan is joining other corporate giants in limiting international travel, broadening its restrictions to avoiding all non-essential international trips, not just to those places hardest hit. And in the United States, with the first case of suspected community transmission, the CDC broadening its guidelines for testing. Now, anyone who is hospitalized with fever and respiratory problems, who's traveled to an area of concern, or whose disease isn't explained by other diagnoses, like flu, will be tested. Guys?
Meg, thank you very much. For more on the coronavirus, let's welcome Dr. Sarah Madad. She is Senior Director of New York City's Health and Hospital System-wide Special Pathogens Program. Dr. Madad is also Principal Investigator with the Center for Global Healthcare Special Pathogens Preparedness. She was recently featured in the Netflix docuseries Pandemic. And Dr. Madad, it's great to see you. Thank you for joining us again this morning. A lot more questions people have about how prepared we are for this right now. What would you say to that?
So everyone across the nation is ramping up their preparedness. This is something that we know is very concerning. China has given us this window of time, if you will, and so we need to make sure we're using this window of time very effectively. Everyone, all healthcare systems need to look and brush up on their surge management plans. They need to make sure they have good staffing, space, systems, processes in place to be able to care for patients that will present with coronavirus disease. We don't know how many are circulating or, already in the United States. The first case in California was a wake-up call, something that we were expecting. We don't know how many more are out there. So we need to ramp up diagnostic capabilities, and we're glad that CDC has finally broadened their clinical case definition. So now clinicians can test people that they think have the coronavirus disease without a very narrow, process in place with the
Meaning you could only test people before who had recently come back from one of the affected areas or who had been in close contact with someone who had come back from one of those
Exactly.
areas?
It was a very narrow clinical case definition, and we know that there are over 36 countries reporting coronavirus disease outside of China. And in fact, if we look at it today, there are more cases mounting outside of China than even inside of China. And so broadening the clinical case definition, it should have happened weeks ago, unfortunately, but we're glad that it finally did happen.
Hey, doctor, what's your professional judgment whether the arrival of spring will do things to take the case numbers down? Will warm weather do to this virus what it typically does to the flu?
Well, I think a really great country to look at is Singapore. And Singapore, obviously, if you look at the temperature there, it's almost summer, and there are still cases that are coming up in Singapore, which shows that even with warm weather, this virus may not actually go away. So with seasonal flu, we know that it is more common during the winter months, during the cold time. It's actually around all year long, but it's more common during the winter months. But I think in Singapore, you're seeing that the cases are still arising. So we can't really tell, but I think Singapore is a country we should continue to look at.
Last question. One of the things we've talked about all morning is what the Fed can do, and part of the argument about what the Fed can do is trying to create some space, a little bit of a pause button, so that the medical community and the rest of the world can try to understand this disease. I shouldn't say disease better, but understand coronavirus better. And so the question is, how much time do you think it would take for us to understand this? Because you do have so many different views about the severity of this situation.
So it's very important to get the full picture in order to understand what we're dealing with. However, at the same time, the more you wait, the more human toll is going to mount. And so we need to continue to look at public health measures and implement public health measures. At the same time, we need transparency in data to understand what is the severity.
But do you think in 2 weeks you'll know? We'll have a really a meaningfully better census? Is it a month? Is it 6 weeks? Is it 8 weeks? Is it? I think that's what we're all trying to get a handle on here.
The timeline is very, very difficult to establish. We're only 2 months into this particular outbreak, and if you look at previous outbreaks, we usually actually don't know the full effect until after this entire outbreak essentially is over, and that's when you're able to look at the totality and the overall case picture of how many deaths are associated with this particular disease, what is the case fatality rate. So right now everything is a guess. So right now, even though we're saying 2.3%, that may very well change tomorrow or the next day. But at the same time, we just need to rely on the information that's coming out right now and making the decisions based on science that we're seeing at the very moment, because we need to make sure that we have a good pulse on, again, the human aspect of it, the societal aspect of it, and the economic aspect of it.
Dr. Medad, thank you very much for joining us. Hope you'll come back again soon.
Absolutely.
Thank you. When we come back, we do have much more on this week's big sell-off and how it can affect you and your portfolio. Right now, as we head to a break, let's take a look at some of the stocks that have been extending their losses in the morning's pre-market trading. Dow, which has been the biggest laggard that we've seen for the week today, down another 2.6 this morning. Boeing off 2%, same for Microsoft and Apple. We'll be right back.
The question wasn't really, how does Royal Caribbean become digital? But the better question was, how do we give customers back time in their vacation?
Royal Caribbean set a 5-year roadmap that included us first identifying, setting up a digital organization. One of those things was the need to transform the guest experience. EY helped us look at the view of digital from every different angle. We're going to be able to make that experience even better than it is today.
It's just a quarter, right? But what if Acorns automatically saved that quarter every time you bought coffee for a month? What about a year? 10 years? And what about the change from food, movies, parking, gas? What about the change from everything you buy? And what if Acorns invested it all in the market where it can grow through the power of compound returns? What if you didn't have to change your life to change your life? Then it's not just a quarter, is it?
We tried 2 different real estate agents who both promised great results, but after almost a year on the market, we still hadn't sold our house. Then we found HomeLight, which promised to get us in touch with the top agents in our area. We went with the agent they recommended, and it worked. HomeLight's agent sold our house when the others couldn't.
HomeLight compares data on millions of agents, so you know you're getting the best agent for your needs.
Oh yeah, we recommend HomeLight.
Get started for free today at homelight.com.
Angie's List has everything you need to know to hire the right pro. Check a pro's reputation by reading verified reviews and browse special deals on home projects. Find all the pros you need to know, all for free. Go to angieslist.com today.
Yes, I'm stuck in the middle with you.
No one likes to feel stuck, boxed in, or held back, especially by something like your cloud. It's a problem, but the IBM Cloud is different. It's the most open and secure public cloud for business. It can manage all your apps and data anywhere, so it can help take on anything, from rebooking flights on the fly to restocking shelves on demand, without getting in your way.
At Fidelity, online U.S. stocks and ETFs are commission-free. And when you open a new brokerage account, your cash is automatically invested at a great rate. That's why Fidelity leads the industry in value, while our competition continues to talk.
Seeking safety from the sell-off. Finance expert Jeremy Siegel. Where investors are turning now as global markets hit correction territory. Squawk on the Street, 10 a.m. Eastern today. Watch and listen live on the CNBC app.
A global stock rout. It has been a historic week on Wall Street, and it's not over yet. The coronavirus spreading, and so is the sell-off. The Dow falling almost 1,200 points yesterday. That's the biggest one-day drop point ever. The S&P 500 is down more than 10% for the week. That's the fastest ever correction from an all-time high. Our mission this morning, help you navigate the steep and sudden sell-off with insight that you can only find right here on CNBC. The final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. We could not have a better guest host for this morning. A man, I'll say it again.
Don't say it, Joe.
A man that the president actually called out, President Trump, as a potential replacement for Chairman Jay Powell. We can't change history, Kevin. That actually did happen. Not saying that you would take it if something were to happen to Jay Powell, but you could conceivably be offered the job at some point in the future. You would at least acknowledge that.
I could conceivably say no. Jay Powell is the Fed chairman.
I know.
And in all candor, this is a time where the country needs to rally around the Fed chairman. This is not a time for divisiveness.
But for people that don't know who you are and you just look like some handsome young guy, you were there during the financial crisis, you were on the Fed, and you were very frequently mentioned as maybe even heading up the Fed. So there, we've said it again. is that okay? You all right with that?
You didn't want it, but you did it anyway.
I did it anyway. U.S. equity futures at this hour down 350 points on the Dow. They've been down 600. They've been down less than 200. We're really keeping a close eye on the 10-year note as well, which got as low, may have even been below 1.17. That was the low that I saw on the 10-year, 1.17. We're at 1.21 this morning. And if you're not following things that closely, when people are really scared, they rush into safe havens, and the more scared you are, the lower the yields go. So if it comes back a little, it would be actually a positive, higher rates on the 10-year. So we're kind of hoping that it's stabilized. I'd like to see 135 by the end of the day. What do you think, Andrew? Unlikely.
I think it's unlikely. I think Friday's good. I think this is going to be a difficult day, but as you said, when I say it's a difficult day, maybe that means it's going to be an easy day. We can only hope.
Right.
Meantime, stocks have been falling across the board, with a number of indexes falling below key levels. CNBC senior markets commentator Mike Santoli is joining us right now with a look at some charts that investors need to be following right now. Mike.
Yeah, Andrew, aside from the levels, just the steepness, the velocity, the intensity, the indiscriminate nature of the sell-off, pretty historic, but it is worth comparing to prior instances. Look at a 3-year chart of the S&P 500. The fact that we were at an all-time high and essentially went vertically down more than 10% resembles this January 2018 drop. Why is it relevant to talk about that one? Well, a couple of reasons. One is because it started at an all-time high as opposed to when the market was already under distress. And what happened after that is usually what happens. You're seeing a lot of the kind of oversold indicators, the fact that there's been nowhere to hide. Everything that you would want to say in terms of a capitulative type action is lining up right now. But you always see this kind of chopping action, even after you have the meaty part of the decline in place. The cautionary thing is what happened later that year, September, October. This looked like it was going to be the same kind of deal, and then you lost it again. Why? The market lost confidence that the Fed was offsides and all the rest of it. We know the history there. So that's obviously the downside scenario, but really we've done a lot of work on the downside so far this week. Now, this is one issue that has also popped up. This is the high-yield bond ETF against mid-maturity Treasury, so essentially a comparable Treasury. So when you see Treasuries rallying, that means Treasury yields going down, and then you've just recently seen a real intense rush out of high-yield debt. So that means credit spreads are widening out. People are demanding more compensation for risk. The record outflows on a one-day basis from this fund yesterday. You guys are talking about what the Fed can do. I mean, this is one element of financial conditions and dislocation that a Fed rate cut arguably could help, because that also is going to feed directly into corporate confidence and corporate behavior if, in fact, the credit markets on the corporate side start to deteriorate, guys.
All right, Mike, thank you. Coming over to the table, also with us this morning is Krishna Mamani. He is the former vice chair of investments at Invesco. Our guest host, as we've mentioned, Kevin Warsh, is with us today. Krishna, you're the new guy at the table, so let's talk a little bit about what you've seen. You had been calling for a pullback. You thought we'd see 10%, but we got there awfully quickly.
Yes, so I think I've been probably the longest bull who has showed up on your show over the last 10 years. But this time is different. This time is different because we are talking about a disease that has a significant impact on activity level that cannot really be changed. And I think that is the key point. Everyone seems to be focusing on the infection, but real issue for investors is the impact on activity. So if things are going to turn around, it's going to turn around because we are seeing a bottoming on the impact, bottoming in terms of the activity level.
And the economic impact.
And that is not going to come from what's happening in California or Italy. That is actually going to come from China. Because China has dealt with this situation the longest. We'll get Chinese PMI. If the PMI is in the 40s as opposed to 30s, I think the market bottoms out. But we don't know that just yet. So as an investor, you are in a risk management mode, and what risk management requires you to do is to basically fall back and wait for a better, stay alive to play another day.
If it does look like the incidence is peaking, and it's hard to believe that, they're not testing everyone, obviously, but if you do start to believe that it's peaking and President Xi starts what he started last week, and that is talking about sending people back. We got to get these things reopened. We're going to do it either way, and he did start doing that. So if both of those things happen, that could be a model for what happens.
That is exactly, if the market is going to turn around, it's not going to turn around because we found a magic cure for the infections or all of a sudden things died down. I don't think that is likely to happen. What is likely to happen is the impact on the activity level starts bottoming out.
Can we just say, though, China took some incredibly severe restrictions by really quarantining millions of people and tying down those areas. If we are watching it be effective with China coming out of this and saying they are not seeing lots of new cases, we still have to live through that here, potentially.
Oh, absolutely. But I think the difference between China and the U.S. or Italy, for example, or other countries, is we are aware of what the potential is. Mm-hmm. And therefore, the effective steps that people are taking more severe, which kind of counterbalance that. I'm not an epidemiologist, but what I can tell you is if things are going to bottom out, it's going to bottom because things are not as bad in China as they looked like a month ago.
Kevin, let's talk a little bit about what Mike was just mentioning. What could be useful from the Fed is the idea that you've seen those high-yield bonds that have really had investors pulling back in a big way from them. If the Fed cuts rates, that supports that issue. But I start to think about it. I mean, I've thought that high-yield bonds have not been given enough scrutiny by investors for a while, that they've been riding along at those same rates. That's a good thing or a bad thing?
So there's been a lot of complacency broadly across these markets, and to some degree that's been encouraged by central banks over the last 9 years. But the complacency gets destroyed pretty quickly. There's been a tough last 36 hours in the credit markets, especially in the lesser quality, high-quality names, as was referenced earlier. So central banks spend a lot of time thinking about what's happening in credit markets, seeing it, and they have to be somewhat troubled by events of the most recent day or two.
Mike, I start to wonder about potential deals that had been in the works. How many of those are just frozen at this point?
I think a lot of things. First of all, I mean, just to stay with corporate credit, there was no issuance of corporate debt for the first 3 days of this week, which is rare. I mean, it's been a very wide open market. So that you're starting to see that almost immediately. We're not seeing IPOs. I mean, I think that does go on a standstill. And it does speak to just the speed with which we've repriced these markets. And it's similar, like I said, to what happened in 2018, but almost more so. I think the issue is, I mean, to Christian's point, we're not waiting for the soothing headline that tells us everything is okay. Right. You're waiting for the market to rush to a place where it's already priced in something really nasty, and then we get something less nasty. Or time goes by. We don't have it's close. It's close in time. It might not be close in price. Maybe you need more of a whoosh down. Maybe you have to scare more people. I think one of the issues that's also knocked loose is that you had people here, investors, overcommitted to a subset of stocks that are now just being completely exited, right? So you have Microsoft gets to 185, nobody can find a reason to sell it. It's in the 150s right now. Not really because of the coronavirus fears, but because people own too much. And so now that kind of idea that, volatility's low, rates are low, we can own more equity risk is going in reverse.
I think two observations on that count. I think credit markets have certainly priced in a bit of the downside, but I think relative to what the potential is, they are nowhere close. So
they're not leading us into this.
Absolutely, right. And I think from that standpoint, to Mr. Walsh's point, if the Fed wanted to arrest this downtrend, they actually have an opportunity, and that'll have an impact on the credit markets. The second thing, as an equity investor, I want to believe what Mike's saying, but I can't. I don't know.
You want to believe which part?
You can't believe which part?
The fact that it is close to the bottom, because I think I think
you didn't say that. Though.
Yeah,
I think it's a plausible place, but guess what? We overshoot all the time.
Absolutely, and I think if this was really driven by analyzing what the Fed is going to do, or what U.S. Congress is going to do, or what Mr. Trump is going to do, we can speculate. This we cannot. So I think that's the difference about this relative to every other point.
I agree with that, except that we've always had these situations before. We've had wars. We had 9/11, where you had this incalculable, set of possible outcomes, and nobody had a feeling that you had a grasp on exactly how it was going to go. But the market, kind of.
And you're absolutely right. You're absolutely right. But that evidence as to where it'll stop is going to come from. We don't have yet. It'll come from China.
Do you think this is a circumstance? We keep talking about this firewall, this idea of this, or a piece of news or inflection point. Is that what you're waiting for? Or do you think that there's
I think it'll
sort of herd mentality where everyone's going to go, okay, this is where it is? What's the?
I think what I'm waiting for is what the actual impact of all of that is. All of these things is on the activity level. That gives me, if China
you're not getting that for a while.
No, but the Chinese PMI is coming out in next week, so I think we will start getting evidence. I mean, if it is in the 30s, then we have huge issues. If it is in the high 40s, then we can look at it and say that, look, things can get really bad, but they can come back. We don't know that just yet.
And by the way, when I'm talking about these sort of tactical conditions, what you typically will see is a crazy rally off the low that gets a lot of kind of momentum behind it, and then it fails, and then you have to rethink it, or then you have the information that comes out that we were afraid of at the lows, and we have to have a test.
I think there's a risk of that happening with the Fed rate cut. So that is something that we have to be somewhat mindful of. That the Fed cuts, let's say this weekend. I'm speculating. Let's say if they do something and
you can just come out with an announcement the way Kevin has talked about that doesn't necessarily continue.
Yeah. But I think that'll give a temporary relief to the market. But I don't think that can be sustained. For it to be sustained, you have to have a good handle on what the impact is on activity level. We don't have that just yet.
Kevin, what you've talked about, this idea of stepping in and trying to take a forceful stance early and calm some of the fears, it strikes me as very similar to what Scott Gottlieb was here talking about yesterday from the medical perspective on this, the former FDA commissioner who said, look, this is not a time for fiscal austerity, fiscal conservancy. You have to step in now. You have to act very quickly, and that's your only way to try and arrest this problem before it becomes a worse problem. It sounds like that's the same advice you're giving to the Federal Reserve.
And it's particularly true when your toolkit is not as full as you want. It might sound as though if you don't have too much left, you better hold on to it. It's quite the opposite. If you don't have much left in the cabinet to use, you better use it early where it can have its maximum effect, and you better find some partners along the way.
I mean, isn't this what you're saving the 150 basis points for? Is something like this that we're seeing? I mean,
yes.
Or at least some of them, not necessarily.
Not everybody.
And also, I mean, I know you would have made this point, but, the markets were soothed with words for months last year before there was an actual rate cut. So there was a kind of rhetorical change in posture or a commitment that was sort of put out there in the world to say, okay, now we're leaning in one direction. The markets were at a new high by the time they actually cut rates.
So you suggesting that even the stance, even just changing the stance to say we're not in a holding pattern anymore?
Perhaps, yeah. I mean, look, what have they been leaning on? Undershoots of inflation targets. That hasn't gotten any better. You've seen what's happened with oil. You can see what's happening in the inflation, kind of forward expectations of inflation in the last few months. it's gone down, not up. So my point is the case is there.
Again, I would urge a bit of caution on that front. And I think from this standpoint, that is, as the Fed looks at this and they want to unfold whatever is left in their tool chest, they just have to be gradual about it, because if they shoot their wad in one go, let's say 50 basis points, and things go down in a meaningful way, we'll have a larger problem. I think what they are probably better served is if the Trump administration starts making contingency plans on the fiscal front. And if there is a coalition that kind of can get to that point quickly, even if the spending is later on, the impact of that would be far more meaningful than a Fed cut.
Kevin, what's your response to that?
So this is one where you need all hands on deck, Becky. We don't know the contour of this. Monetary policy is not well situated to deal with it alone. And moreover, the rest of the world, like Europe, is closer to a recession by far than the United States. So the global response doesn't have to be limited to monetary policy. And this is the moment for the world's leaders from all agencies to stand together and to step up.
You think central banks from places like Europe, where they are looking much more closely at a recession coming soon, would be open to this idea right now?
So I don't know, but I think there are still quite a few things they could do to support the economy. There, it's more likely to be dominated by fiscal policy. But as Mike said earlier, if you weren't ready to send in the strength now, I don't know when you would be.
Krishna, Mike, want to thank both of you guys for being here today. It's great to see you. Kevin, of course, is with us for the rest of the program.
Okay, we want to get over to Phil LeBeau because airlines have been the hardest hit sectors this week. The NYC ARCA airline index down now more than 20% in the last 5 days. And while coronavirus fears have sparked this sell-off, it follows months of bad headlines, of course, on Boeing. This morning, we're hearing from Spirit Aerosystems, which makes the fuselage for the MAX. And Phil LeBeau joins us right now from Chicago. Phil.
Andrew, not a surprise that we see a loss for the fourth quarter earnings reported by Spirit this morning. The estimate on the street was for the company to earn $1.65 a share. It came in earning 79 cents a share. Revenue just a smidge better than expectations, coming in at $1.96 billion. In the fourth quarter, because the 737 MAX production schedule had been cut by Boeing, that meant that Spirit Aerospace took a $34 million hit in the fourth quarter. Remember, they're building the fuselages for the MAX at the company's facility in Wichita, Kansas. They've got about 100 of these that have been built but not yet delivered out to Boeing in the Pacific Northwest. Their 2020 guidance, they are not giving it right now, given all the uncertainty surrounding the 737 MAX. As you take a look at shares of Spirit, no surprise here. This stock has been hammered. We're looking at it trading around 2016, 2017 levels. They have a plan in place, an agreement with Boeing to build 216 737 MAX fuselages this year. And speaking of Boeing, you guys mentioned earlier, it is under pressure pre-market, down in the $281, $282 range. The last time we saw this stock trading at this level, guys, you've got to go back to maybe November, early December of 2017.
Yeah, just what Boeing needed. So anyway, thank you. Thanks for that. Our guest host this morning, Kevin Warsh. President Trump mentioned Kevin during the signing of the U.S.-China trade agreement back in January, saying Kevin should have fought harder for the Fed chairman job.
Kevin Warsh. Kevin, where's Kevin? I don't know, Kevin. I could have used you a little bit here. Why weren't you more forceful when you wanted that job? Why weren't you more forceful, Kevin? You're a forceful person. In fact, I thought you were too forceful maybe for the job. And I would have been very happy with you.
His ear's just burning a little bit there, but what do you think he meant by that? In terms, you wanted to keep rates high at some point, or you were arguing for... When did you push back? What do you think he was referring to? You don't know.
I couldn't speculate that on Joe. Could you?
I come up with a few scenarios, I think, but you've made a very forceful case today for some easing globally, I think, with central bankers, even though we're already negative most places. That is not what I necessarily would have thought your tack would have been, given some of your previous comments that we should have been raising rates through a lot of the last 3 or 4 years, right?
So when the facts change, we change. That's what we're supposed to do. And there's too much discussion about who's a hawk and who's a dove. The best central bankers, going back to Chairman Volcker and others, react to changing circumstances.
And react quickly, I would suggest, too.
Absolutely. They react with imperfect knowledge because that's the nature of this business. And they react with all the team members they can find, especially when they're running low on ammunition.
Does total debt levels before the coronavirus aside, I mean, we were in a precarious position to start with. Or do you believe that, or not?
There aren't that many left that do economics that are concerned about levels of deficits and debts. I am an old-fashioned person, and I still am. On a relative basis, the U.S. finds itself in a very strong financial position. On an absolute basis, we find ourselves in a weak position. So it reminds me a little bit of the financial crisis, when most, if not all, of the banks were insolvent, but some were going to be the last ones to survive. Similar to the U.S., the U.S. certainly has all the capability and all the flexibility to do what's necessary if this turns out far worse than even current expectations to expand with a large fiscal package.
If the Fed doesn't do something Sunday or doesn't get to the weekend or doesn't announce something Monday morning after you've been so outspoken about the need to do something like that, are the markets listening at this point to you to the extent where there would be disappointment on Monday if nothing happens?
They're not listening to me. They're listening to Chairman Powell, and they're listening to his colleagues. I don't think it's really a question any longer of what will they do. I think it's a question of when. They have a regularly scheduled meeting on March 18th, but there's a lot of time between now and then, and the data and the information can come in on both sides of that. I wouldn't want to prejudge it, but you've heard my sense, which is in the crisis, we probably didn't act soon enough. The gloss of history suggests somehow we nailed it. But we had a hard time finding our feet at the beginning of that, too. And I think that the Fed will find its way. I think they will navigate us out of this successfully. And I think this will show a period where the Fed can go back to what's an old-fashioned job, to dealing with tail risks, rather than the new fashionable job of trying to micromanage an economy during peace and prosperity.
Yeah, what kind of political pressure do you think is going to be on Jay Powell and the Fed this weekend? Meaning, we've talked about political pressure, and you've lived with it with the president calling you out publicly. But in terms of the political pressure on Jay Powell, the White House, and others from Treasury calling Jay Powell, do you think that's happening right now?
So I don't know, but I think Jay Powell has handled that very well. It is not helpful for the institution that we all care about, for the administration to be taking shots at them. Fed independence is up to the Fed. I have a lot of confidence that Chair Powell and his colleagues will call it the way they see it, and it won't be because of political pressure.
Have you spoken with President Trump about your op-ed since it came out?
No, I haven't. I scarcely have spoken to him since the interview, which you guys referenced at the beginning of this.
Kevin, when did you feel like this was developing as a crisis that needed action? I mean, this is something that's changing pretty rapidly on a day-by-day basis.
So my views on this probably changed a little more than a week ago, and there was some hesitancy before I decided to put pen to paper and put it in the newspaper and come on this show. You know, quite frankly, I didn't want to make the job of the Fed any harder, but I thought about what Marty Feldstein did to us in the depths of the crisis. He's a dear friend. He was a dear friend and a mentor and a great man and a fine economist, and we miss him at a time like this. And he gave us some tough love when we were at a Jackson Hole conference, and we didn't want to hear it, but he made us rethink. And so maybe that was in the back of my mind, and I said I really shouldn't sit on this anymore and see whether I can't prod institutions to think a bit more aggressively about this moment.
What kind of feedback have you gotten from your fellow economists?
It's been reasonably divided. I must admit I've received a lot of emails from that op-ed, both from the left and the right. Some saying, oh, I thought you were a hawk, and others saying, oh, you're not going far enough. What will 25 basis points do? But frankly, this discussion is the right discussion that needs to happen in the economics profession. Good economics isn't about what's fashionable. It's about wisdom from the last 100 years, and wisdom says go early.
What would Ben Bernanke say?
So you should have him on the show. I don't know, but I suspect, this is just a suspicion, and Ben Bernanke did an exemplary job in the crisis. He's a mentor and a friend, but I would be of the view that he would think that acting sooner is better than acting later.
If you're just waking up this morning, I want to get you up to speed on where the markets stand at this point. Take a look at the futures. You'll see that right now the Dow futures are indicated down by about 360 points. We've seen down as much as 650 points this morning, but also down by less than 200. So this is looking to be another volatile day, at least before the opening bell. You can see the S&P futures are down by 42, the NASDAQ off by 118. Now, just to put this in perspective, yesterday the Dow was down by almost 1,200 points. It was the biggest one-day decline in terms of points that we've ever seen. It was an additional 4.4% on top of all the losses that we've seen all through this week. Right now, the S&P futures indicated down by 43, the NASDAQ off by 120. And if you take what's been happening in the European markets that are open right now, you'll see that there are red arrows across the board there, too. Declines of 3% for the FTSE. The DAX is off the biggest percentage decline right now. It's a decline of 3.25%, but none of those markets off by less than 2%. Also been watching the 10-year very closely because the 10-year, the bond market's really been the one that's been pushing the stock market around. And right now, the 10-year is yielding above 1.2%. Those are historically low levels, but better than we saw earlier this morning when that fell all the way to 1.17%. So right now, 1.218% on the 10-year.
Even a casual observer has obviously seen what's happened this week, so you don't have to be an avid stock market aficionado. Even if you have a 401k, I'm sure you know what's happening. And the markets and many widely held stocks have dipped into bear market territory. The historic sell-off may have many people worried about those retirement plans, 401ks, and other investments. Joining us to discuss the state of the retail investors, J.J. Kinahan, Chief Market Strategist at TD Ameritrade. And in breaks in the past, J.J., I've seen times when the average investor and people not quite as close to the trees in the forest have actually fared better and maybe not panicked as much as the professionals. What are we seeing this time around?
Yeah, I think you bring up an important point. We always hear don't be emotional about it. And it's kind of interesting that most of the people I hear that from are managing other people's money instead of their own. And so the one thing I would say is the first thing is people do get emotional about money. You know, I just read recently it's the #1 cause of fights in a marriage. But taking a step back, if you are nervous, don't think all or none. I think that's the mistake people make, Joe, is they get nervous and they sell out their whole portfolio. That is a huge mistake in most cases. You know, if you're really that nervous about it and you have to sell something, make it a small percentage. And in fact, longer term, what tells us is these are often nice times to buy. Not saying, you know, you guys had a great discussion a few minutes ago with Mike about, is this the bottom, isn't this the bottom? Nobody knows for sure. But, I really think the partial, if you will, mentality, thinking about buy a little bit here. If we go lower, you still have money to spend if you still like the stocks, et cetera. And if you got to sell just a little bit right here. Overall, that's one of the biggest differences between professional and a retail investor.
When we look at sentiment and things like the VIX or put call or all these things that you have watched for years and years and years, what are you seeing, and it's been very sharp, but it hasn't been that long of a time. We pointed out again and again, this is the quickest correction that we've seen in many, many, many years from the highs. Have we done enough work instilling fear at this point to make a tradable bottom, do you think, JJ?
I think we haven't, Joe, to your point about it being so fast. It's also been, you've seen many sell-offs also. It's been incredibly orderly. I mean, they're really, besides yesterday on the close, when there was so much stock to sell, and they really slammed them, and, you guys are showing the fair value, and you see how much the S&P 500 closed under fair value. There was just so much to sell on the close. Outside of that, this has been a very orderly sell-off. And with that, we saw gold and we saw bonds, 2 of the 3 sort of, measures of risk, in my opinion, then along with VIX, all starting to go up. But with that, they remain elevated. Many of our clients are turning toward more, risk-off assets. The way to look, I'm looking at it right now is, in a sports analogy, the defense has been on the field all week pretty much, and I think the defense may stay on the field for much of today. The thing I'm most interested in today, before we talk longer term, is can we muster some sort of a rally before the close? Because I would think people want to unwind their positions who have shorter term positions on the close. For those with their 401ks and longer term positions, This is a blip on the radar. If you're nervous, look at how you've done for the last 2 to 3 years. I'm going to guess overall it's been pretty good if you've stayed invested. So don't let 1 week, change all your decision making.
Okay, JJ, I want you to stay with us. I want to take a quick pause. We got some economic data that's crossing the tape. January personal income and spending. Rick Santelli is standing by the CME in Chicago. Rick, sir, the numbers, please.
Well, Andrew, we're expecting a number on income that's roughly up 0.4, maybe a little bit lower on spending. We end up with another set of better data points, up 0.6 on income, up 0.2 on spending. Arguably, spending might be a tenth light. And in the rearview mirror, we gain a tenth on spending from up 0.3 to up 0.4 from December, and we lose a tenth on income from up 0.2 to up 0.1. Bundle them together, pretty good. Now, if we look at the deflator month over month, that's up 0.1. That's 0.2 less than December. Year over year, 1.7, 0.1 hotter than December. And year over year, core 1.6 versus 1.5 slight revision. We also have advanced goods on the trade side. That's minus 65 billion. That's about 3 billion light of expectations. Of course, it's a minus sign, but it's a bit smaller minus sign than we were expecting. We still have inventories just popping up. On wholesale inventories for the month of January, down 0.2. We're expecting an up number there. So, of course, that may have implications for first quarter GDP, and especially on that first quarter GDP. Yesterday we saw the GDP now move to up 2.7 versus February, I think, 19th, up 2.6. And while all this good data is going on, we traded 94 basis points already in a 2-year note yield. And we settled at 147 last week in a 10-year. That's now at 121. And I believe it was down to, 115 earlier. So I guess Becky, Andrew, and the gang, the way to look at this is that we are now at extremes trying to find a footing in treasuries. And until the equities look a little bit more stable, that's probably not going to happen. The machines will rule. Just watch that 200-day moving average. Do I think it's the best gauge to trade things like S&Ps? Personally, it's a tool, not the greatest tool. But when it comes to the machines, things like that are important. You break a threshold, machines turn on, non-emotionally. Becky, back to you.
Rick, we've been talking so much about the 10-year yield today and watching that tick by tick. I assume you're doing the same?
Oh, yeah, absolutely doing the same. And I'll be quite frank, yesterday I thought we would get to, that midday bounce. I got a little carried away, thought it would carry us farther. But I thought it was a learning lesson because, the Treasury market, once again, the bounce was so meager. I really do think there's a good chance, and this is not rocket science, but, the 1% psychological, whether we slice through it a little bit or just get closer to it. But in the end, we shouldn't lose sight of the fact that much of what's pushing our rates down has less to do with us and more to do with the rest of the world.
Rick, do you think that this catches up in the mortgage rates at some point? I mean, I actually called yesterday, and they say, no, you're in a decent rate right now. Don't get excited about this, to try and refinance. Does that show up at some point where it actually gets significantly lower for people?
You know what? The correlations, of course, are always spotty, but they're high with regard to, 10-year note yields and your average 30-year fixed mortgage. When you have active weeks like this, that's going to have to catch up a little bit. I would put it this way. If we all have friends or relatives or associates thinking of refinancing, I think there's a whole lot more that would tell me to tell you to refinance than not to, given how much more you could gain with lower yields and how much more you could lose with higher yields. Having said that, I don't see over a 5-year horizon them going very high, but I think it's a green light if you're looking to refi. Don't hesitate. Make that phone call.
All right. Rick, thank you. Great to see you.
Thank you.
Steve Leisman joins us right now with more on all of this. What do you think, Steve?
Just real quick on the data, going into something like this with better income numbers is better than going into it with worse income numbers. So again, we're going to start to measure the impact of this. We believe in February perhaps would be the first data we'd get. Maybe we'll get some in the first part of March for the late February data. And that will tell us the initial impact. But I do want to tell you about an exclusive CNBC poll we have of chief financial officers, pardon me, from leading companies around the globe finding the effects of the coronavirus already being felt. And there's concern about more to come. The poll of 30 CFOs from North America, Europe, and Asia finds differing amounts of connections to China, but not one executive reported that their business has been immune to the virus so far. 100% say they have made changes to their businesses because of the virus. 88% have some form of business connection to China, and 63% say there's been an impact on either the supply chains or demand from their consumers. 63% say demand for the products and services they sell in China has declined since the start of the year. Just 22% say, hey, there's been disruptions to supply, but 38% are saying, you know what, it's too soon to tell if we may yet have a problem. And there are differences. Do you want to interrupt Andrew for something?
It sounds like we have some breaking news right now, actually, on United. And we want to get to Phil, if you could just pause for just a moment. Hey, Phil, you with us?
Yeah, I'm here, Andrew. We've got some breaking news from United Airlines. Not a surprise, given what's happening with the drop in demand completely going away for China and falling more than 75% to trans-Pacific routes. United is going to be reducing the number of flights going into Tokyo, Narita, Osaka, Singapore, and Seoul. I'm not going to go into specifics with each of those markets, but suffice it to say, United bringing down the schedule, not canceling outright, but bringing down the schedule. But it is extending the length of time where it will not be flying from its U.S. hubs into China. That now has been extended out until March 30th. So United reacting to the fact that there's no demand for flying into China right now and a severe drop in demand in terms of flights over to Japan, Singapore, South Korea. That's why they're reducing flights to those Pacific destinations. Guys, back to you.
This is a demand story. There's no
it's not a safety issue if you're still sending planes in.
No, it's a demand issue, guys. Exactly. It's a demand issue. And this is the smart move. If you're United, if you're Delta, if you're American, look, if people aren't going there, if they're not booking these flights, just don't go. Just sit the aircraft down. It costs too much money to make these flights with only 30% of the
Kevin on this, because we've been talking about this. This is the piece that I think the Fed can't solve. That no matter what the Fed does over the next week, if they do something on Sunday night, Monday, if they don't do anything, that no matter what they say, it's not clear to me people are getting back on the plane.
I don't think that's accurate.
You don't think so?
Well, I'll tell you, because it requires me to have a conversation with Phil that I don't think we want to have, which is, in this world today, when airplanes are not supposed to be sitting for 3 minutes, the idea that these planes are idled means tremendous losses to the outlook, and whether or not there's a lot of debt out there in these airlines. Mm-hmm. So if this becomes an issue of refinancing debt, of an inability of an airline, and this is the part you don't want to have the discussion.
None of these airlines are in that much trouble, though.
Well, I was going to throw that to Phil.
What a great time to refinance.
Right.
Well, okay. Phil, I mean, is there an issue about sustainability? I don't mean of United, but of any of these airlines. They may not have a lot of debt relative to what they used to have, but running an airline requires an awful lot of debt out there. And would any of them benefit?
I understand what you're saying, Steve. Look,
Right,
should people be worried about the U.S. carriers? No, their balance sheets are in good shape. That's not a concern.
Berkshire Hathaway owns like 10% of every one of these companies, and I can't imagine.
But the issue starts up. Look, we always say it's a low barrier to entry to get into the airline business. Rich people do it all the time. They're like, well, I'm going to go out and buy some planes and start flying different places. Norwegian Air, perfect example of an airline that does not have the strength of a balance sheet that you see with a United, a Delta, and American. Okay. That's the type of airline, as the drop in demand happens, that you're going to see the impact.
Because the airlines have been smart, and a lot of the debt that finances the airline industry is out with the leasing companies. So
right,
and
But the conversation right now, Steve, I just so you guys know, the conversations that I've heard from people in the airline industry, those who are with leasing companies, is that those leasing companies are already working with airlines, in some cases saying, okay, do we have to defer a payment over a month, a 2 months, 3 month period, or do we buy a particular aircraft? We'll buy it from you because you don't want to sit there and deal with it. Then we're going to lease it back to you, which is a favorable term for some leasing companies. Those conversations are already taking place.
Sure, but I would also say, again, not knowing anything other than what Warren Buffett told us on our air on Monday, just about Berkshire's ownership of almost 10%, in some cases more than 10% of all these companies out here. If they need money, they've got a pretty safe place to go with somebody who has a whole cash hoard.
Although I would just bring it out back to Andrew's question, and I don't think the idea is that the Fed is going to have the answer for every isolated problem and issue and demand shortfall. It's offsets, right? The Fed can affect some parts of the economy. It can encourage more, home refinancing, all the other stuff. So it's a buffer. It's not a targeted solution to everything.
More than we do on this.
So Phil's report, that's what counts for data in a period of stress like this. That's data that should find its way into thinking among central bankers and economists. Steve's survey, that's what's called data now. It's not perfect, it's not scientific, but it's the best you can do amid uncertainty. And both of those are inputs that tell me two things. One, the Chinese economy is slowing and almost assuredly had a negative first quarter. And it is deeply related to the rest of the global economy, and we should all take note. And second, the report that we got earlier in this segment, personal incomes are strong. That means the U.S. consumer is in better shape than they've been for a very long time, and that they're pulling back on their spending over the course of the last 3 or 4 months tells me they're being prudent and cautious. They have the money to spend, but they're not parting with it.
Kevin, let's go to the Wayback Machine into 2008, 2009. It reminds me of the thing that really bit the economy, that really spooked the market, which was transparency. We didn't know where the debt and the obligations were held. And the market just decided we're going to sell everything.
Yeah.
And I'll worry about whether or not Lehman and Goldman have a problem later. But right now I'm just going to sell Lehman and worry about that later. To what extent are we in a similar position in that a period of low rates has created a lot of leverage out there, leverage in the hedge funds? The banks we know are in better shape, but it was one of those things when the tide ran out, we realized who was not wearing a swimsuit.
I think that's accurate.
And I don't want to create a panic where it doesn't belong, but it's one of the pieces of data we may not
have.
Down
12% alone. That is the tide going out, right?
That is the tide going out, and whether or not long short equity funds, whether or not, Mohammed yesterday.
That's where you want the leverage, though, in a sense. If it's going to be somewhere, you've just seen them unwind. The funds that do that stuff, that say, oh, things are calm, rates are low, I'm going to lever up my positions in stocks, they're flat now. That's what 12% down in 6 days was.
That's what we
is them kind of backing away, as opposed to, securitized debt that was basically pinned to household income.
That's not the lack of transparency we're worried about now. Lack of transparency is that we haven't tested anyone.
Right, that's the lack of transparency. It's medical.
Got nothing to do with the leverage at this point. It's whether, is China coming clean? Do we really know over there, and do we really know what's going on?
I think that's a piece of the transparency. I think the other piece of the transparency
about leverage at all.
Is knowing. Well, look, it was Mohammed El-Arian yesterday who, in a tweet, said that he heard that some banks were pulling out from their lending facilities to some hedge funds to be safe. That's the kind of thing where you find out what's really been going on
in China. That there's a million businesses that are going to go under if they don't get help.
So there's no question that U.S. banks have much more capital and much more liquidity than they did in the Wayback Machine of 2008. But we don't have a perfect understanding of the interconnections in the domestic banking sector. And if I'm half right, that the Chinese and Asian economies are suffering from this first, that the European economies will suffer from it next. If we look to some of those financial institutions and some of those connections, there's still a great veil that is difficult for us to assess. And what do markets do amid periods between fear and greed? They run. This is where it's an opportunity for the official sector to try to pull back the curtain, because in all likelihood, the truth is better than markets fear.
The truth is better than markets fear.
On the sustainability of the banking sector, on questions about leverage and off-balance sheet vehicles. Okay. So again, hiding from that is never a good thing. And for the official sector in China, if American healthcare professionals were there and could attest to what was actually happening in the data, I think that would be comforting both for the financial markets as well as for investors in the Chinese economy.
Right. Is Phil still with us, by the way? Hey, Phil, you there?
Here. I'm here.
In terms of the way the airlines are thinking about the next, say, 3 months, right? Because I think the next 3 months.
Yep.
The people you're talking to internally, what kind of projections are they genuinely making about the fall off in both international travel and domestic travel?
Domestic, they're not worried right now. They're not seeing that in terms of fall off in demand. They really are not seeing that at this point. In terms of international, forget about China and Asia Pacific. We just talked about that. China has no demand. Asia Pacific is falling off, 75, 80% for the carriers. Transatlantic is the big concern right now. What we've already seen are the waivers for many of the places that they fly to in northern Italy, some in the southern part of Italy. Their concern right now is what happens if we see some of these virus clusters pop up, let's say near Geneva or near Paris, someplace else. Then you have corporate travel really doing a reassessment here in the United States. Do we send our executives? Do we want to send our executives? Look, the Geneva Motor Show just announced today it's canceling the show that was supposed to start on Monday. So now you've got people, and I heard from people in the auto industry who are like, I'm not really sure if I'm going to go. Well, now, obviously, they're not going. That's the concern for the airlines. It's
Phil,
transatlantic right now.
Phil, I want to go back to our CFO survey, and guys in the back, if you can call up that wall there. We asked businesses what changes they've made so far. 91% of our 30 CFOs said they've restricted air travel.
And I'm sorry, when were these results?
We did this in the last 24 hours. We just did it.
That, to Kevin's point, what
data.
you're talking about and what Phil's
Kevin knows how I
about
feel about this stuff. We might as well talk from 63% said that they've made efforts to allow employees to work from home more. In other words, more virtual work. And of course, 75% said they've done health and hygiene measures or
But what does that mean? Just wash your hands, tell people?
I think just basic stuff. We had a memo like that internally here. But I want to just get to Phil on this 91%. Phil, these are the people that travel in business class. This is the biggest hit to the, and this could be, by the way, half of our respondents were North American, the other half from outside of North America. So how does that play out in the outlook for the airlines?
Well, again, domestically, they're not seeing that, including corporate travel. I've talked with a couple of people at the airlines over the last couple of days who've said, look, we still see strong demand on the corporate side here in the United States. Now, does that shift over the next week or two if we see more concerns about coronavirus? It could, but the real focus right now, it's the transatlantic routes, because that really is the bread and butter for the big airlines in terms of corporate travel. I mean, that's really where they make their money. It's not on you and I booking a leisure trip over to Paris or to London. I mean, yeah, that helps a little bit, but that's not where they make their money. It's the corporate travel.
Just internally, do they give you any guidance at all to say, okay, we're off 10% in bookings domestically, 5%? Do they say anything, or they just say it's not a big deal?
Not enough at this point. Not enough that we can hang our hat on it and say this is what we're seeing in terms of demand. But I have heard, Becky, and I can't stress this enough, the domestic demand is stabilizing right now. It's strong. It has not fallen off. So, there may be concerns out there, but we're not seeing it in terms of what the airlines are seeing when it comes to bookings.
Okay, Phil, thank you. We're going to reset things quickly here. If you're just tuning in, let's get you up to speed on the markets. The futures right now have declined again here to the 500 level on the Dow, down 511 points. The S&P is indicated down, as you can see, the NASDAQ as well. We've been down 600. We've been down around 200 through the morning session. I would assume that the volatility would continue on a Friday all the way up till 4 o'clock. Obviously, when you've got 2 weekend days to hear more about new cases from anywhere in the world, people might be hesitant to stay too long over the weekend. We probably ought to show you the 10-year quickly as well. Things are been pointed out, and Jim's pointed out that stocks really are keying off of the 10-year note as well. It's been anywhere from 1.17 on the 10-year, now 1.20. It's been almost 1.22. Each little basis point all of a sudden makes a difference. Who would have thunk? Anyway, some other market charts are must-sees right now, and Dom Chu joins us now back in EC with some of those. Hey, Dom.
All right, so, Joe, I'm going to dovetail in just a second on one of those interest rate discussions that you just had about the 10-year note yield, but we're going to start first with just a look at the week that was so far with regard to the picture in stocks, because the S&P 500 during the course of the last 1 week period, you can see here, down 12.5%. We've talked about that correction mode, so-called correction mode, down 10% or more. Energy, the real standout during the course of the week, down 18%, the real loser loser in terms of the overall sectors in the S&P 500. Meanwhile, consumer staples only down 9%. Yes, it's terrible, but believe it or not, that's the best performing sector in the S&P on a one-week basis. Now, to your point about the 10-year note yield, we have seen it fluctuate quite a bit. We are at just near record low levels again, set just in the last couple of days. But one thing to pay attention to that maybe a lot of folks aren't watching is the difference between long-term yields and short-term yields, as evidenced in this case here by the difference between 2-year Treasury notes and 10-year Treasury notes. You've heard that referred to as the 2-10 spread. Banks look at this, as a way to kind of gauge their profit margins. But remember, at one point we were negative going toward the fall of last year. We got as high as around 35 basis points, 0.35% there. Believe it or not, in the last few days, we've actually seen the yield curve, or this particular spread, widen out a bit. That indicates that things may be getting back to normal-ish on a relative basis, but maybe that's an early sign of some positivity if you're looking for one. And then one thing to end on, we don't normally want to talk about it as much, but Bitcoin, those prices had been in previous times of some market stress a place for alternatively placing your money. We've seen bids happen much like it would for gold. This time around, though, over the last few weeks, we've seen Bitcoin prices take a move lower here as well, indicating that people aren't even looking there. By the way, we were not just a long time ago around $10,000+ per Bitcoin. Now we're down at 86. So, Becky, it just gives you an idea that the selling is all over the place, not just in traditional stocks. Even Bitcoin is not as attractive these days for some of those folks out there who look towards it as an alternative place to park their money.
Okay, Dom, thank you very much. Let's get down to the New York Stock Exchange. Jim Cramer joins us at this point. And Jim, I've been watching you nonstop, watched the entire show last night, and you've been a very calming voice as we got into some of these things. And it definitely gives you solace, but this is a fast-moving market. You walk in, and right now we're looking down 570 points on the Dow again. Just talk us through what's a panic and what's rational at this point.
Well, look, I think there are people who genuinely believe that we're going to get a sweeping public health issue in, let's say, a lesser developed world. There are people who believe that leaders are going to come down with it. There are people who believe that when schools close in various areas, it must be worse than expected. And then there's me. I mean, I think that we're building in some pretty great negativity. We're back to that ratio, as Joe and you, Becky, know, that late Mark Haynes said, you have to do some buying whether you like it or not, which is 10-to-1 negative to positive. So I think that if you're a 401k, I know that no one wants to hear this, but I think you have to buy some. I thought that when I think about what to do, I say you can't sell unless you have travel and leisure. Those aren't going to work. Autos won't work. Clearly airlines won't work. So if you're full up and don't have any capital, it's still not too late to sell those, but you have to be ready with some index buying here. Just because it's the hardest thing to buy in the world. Everybody feels that Monday's going to be worse than today. I can't take that view. I have to just be automatically putting 401k money to work, whether I like it or not, because I don't have any that I haven't put any in the last year and a half. So you got an opportunity if you have cash, and if you don't, why don't you sell some of those stocks that aren't done going down? But pretty soon we're going to have to not be able to sell anything. So make sure you're a little liquid just in case Monday's bad. But I think it's really about leaders getting sick, and it's about the lesser developed world getting sick.
And school closures here. I mean, I think that's the potential thing.
That's what scares people.
Yeah, that scares
Becky,
people getting panicked.
I think there's two things wrong. One is that Dr. Fauci apparently feels silent. I don't know if he feels silence, but that's bad. But no one really trusts any numbers in China. But the one thing that we do know is if you smoke, if you have diabetes, and you're over 65, you're very much at risk. There's a remarkable group of people who aren't at risk, which are younger people. We've had a lot of babies die of flu in our country. I know that dying of flu is much harder here than with the disease, but it is rather remarkable. We have a lot of people who didn't get the flu shot, and they died in the United States. So, I mean, I think that shutting schools is not necessarily the way to go unless you're worried about the teachers. But I believe that there's a lot of hysteria now. That doesn't mean the hysteria in the first day's bottom. But when you get that level of selling, I'm going to have to default to what Mark Haynes said. I mean, he was able to call the bottom in a period when everything was not great. I know it's really hard to come up with what to do in a biological crisis. It's not financial. So the emphasis on the Fed is misplaced. It just doesn't matter.
Yeah, I'm with you on almost all of that. I think the only thought with closing schools potentially is that kids are carriers. And if they go to school and pick it up and they all bring it home, it's you worry about the older people at home, not just their parents, but their grandparents or anybody else who might be around. But I'm with you. I mean, you could be concerned and do preparation and then also look at this and say, hey, stocks are off 12%. Looks like a good place to jump in.
Yeah, I mean, look, it could go down 12. I mean, I look at Apple and I think, well, why necessarily at this level? If you look at the 10-year chart, you're going to say you're buying at the wrong level. But there's a level to buy Apple. I mean, people just have given up on it. Microsoft, the level to buy it. They both quantified that there's issues with downside. Retail's very hard because we don't know whether people are shopping. But I think that if you're going to be selling the stocks that are at under book value when the book value is scrubbed in the financials, I think that's a mistake. I think that tech can bounce back. I gave you 10 tech stocks last night that really only work best when you have to work at home. Now, Zoom has been up, Ring Central's been up, but they're still going higher. I think that Zoom can go remarkably higher.
I like what you said about Teladoc, too.
Hey, Jim, one question.
Someone downgraded Teladoc. I mean, how can you do that? It's pretty good.
Hey, Jim, real quick. The thing I'm trying to understand is if and when we start to get earnings from these companies, and I know we got a ways for that to happen, does everybody discount these things as a one-time situation?
That's the problem, Andrew.
Or not?
No, that's the problem. The reason why I mentioned Microsoft and Apple, at least they told you. I mean, when you have companies that pre-announce, I mean, watch Columbia Sportswear today. Watch a company that I've never really cared for, Big Lots. Watch Wayfair, which put out some bad numbers. And if they bounce, then I think that what you can say is, you know what? It's a little built in. But my bet, I hate to say bet, is that they won't bounce, and you've got to let that filter through.
Jim, thanks. We'll be watching closely.
Absolutely, guys. Have a good weekend.
Okay, see ya.
All right, joining us now, Kristen Bitterly, head of capital markets at Citi Private Bank, and you were here for listening to what Jim had to say. Do you agree with most of it, disagree, have a different nuance?
So I agree in the sense that I would much rather be a buyer tomorrow than a seller today in this market. In terms of trying to call the bottom, I think that's a very hard thing to do. So a couple of things that we're watching right now. We actually maintain a bear market checklist, which is a series of 18 different criteria, which is trying to tell us, right now it actually tells us to buy the dips. But a lot of that information is based on the strong consumer. It's based on leverage. It's based on debt service ratios that are actually relatively healthy. We also have a panic euphoria model that we look at, and we haven't quite reached that panic territory yet. Once we see that panicked sell-off, then that would be a very clear signal to get into the markets.
Is it possible to just be a purely analytical economics business type person here and say I'm looking at the effects on the economy and what it brings, or don't you have to take into account just the fear of and this being human and the idea of a pandemic?
I mean, it would be amazing if we could say this is all fundamental and economics based, and you see some of that in terms of people looking at earnings growth and revising earnings estimates down. We did that in terms of looking at zero earnings growth or potentially negative for this year, global growth as well. But when you're looking at panic, headline risk, and it's not just about coronavirus. We have the elections coming up. We have Super Tuesday coming up that could introduce even more volatility into the market. So I think it's really a combination of those things. And you add on, I know you guys were talking about this a little bit earlier, a lot of the selling that we're seeing, it's actually not from our investors. I don't have a lot of investors out there that are panicked. It's more the machines and the programmatic trading, and you can see that in a lot of the gap downs that we're seeing in the market. It's not individuals like us or kind of long investors that are saying, I need to get out.
Right. Kristen, thank you very much.
Thank you.
Kevin Warsh is our guest host today. And Kevin, you've been with us through the morning, but as we're heading into the end of the hour and the end of the show, again, the conversations that you think are and should be taking place at the Fed with other central bankers this weekend.
So I don't know what discussions have happened or are likely to happen. I think it would be wise for U.S. officials to hear what's happening on the ground among key allies in Asia, what's happening in global supply chains, what's happening to transports, what's happening to the exports, because we have a global interconnected economy, whether we like it or not. And weakness over there finds its way into Europe first and finds its way into the U.S. second. So at least the sharing of data and then a sharing of tools and how to handle what's likely to be a volatile period ahead. I think for U.S. policymakers, the thing they should find great comfort in is the U.S. finds itself economically in quite a strong position to be able to withstand this shock. A stronger bottoms-up economic position than almost any of our big trading partners around the world. So over the medium term, this is going to be okay, but that doesn't mean that policymakers can sit on their hands.
You've also talked about a coordinated effort with all these other central banks. Who are the banks that would be sitting around the table, keeping in mind that interest rates are negative in many other areas of the world right now?
They are negative, so there's not a super strong, deep toolkit. But every time the world's central bankers are asked to imagine what would you do next, there's been no shortage of imaginations. That's true for when Ben Bernanke led the Fed in 2008. It's been true at the ECB throughout a very rough period of the last several years. Christine Lagarde is a brilliant tactician, is a very capable leader, and I expect that the ECB, along with the fiscal authorities, could come up with things that would matter to the real economy, and in so doing matter to the financial markets.
You think the benefits would outweigh what it would indicate to people if they did this Sunday night? You think it would be better than people saying, oh, my God?
I think exactly that. And the truth is, if it turns out in 6 weeks we wake up and this was all hysteria, not based on reality,
you'd be glad you did it.
Then you'd be glad you did it and you can take it back.
Kevin Warsh, thank you very much for being with us today.
Thank you.
That does it for us today, but clearly the market's still on edge. Dow futures down 607. Let's hand it over to Squawk on the Street.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Kingston here with Jim Cramer, David Faber at the New York Stock Exchange. The market will search for levels of critical support this morning as futures are down 500 plus. Ongoing fears. 2/3 of the Dow's gains from all of last year are gone. Europe down 4%. Consumer spending in France and Switzerland negative in January. And then 2s, 3s, and 5-year yields are now being measured in basis points. The Dow plummeting 3,200 points in a week. That is the worst for stocks since the crisis. Yesterday, it experienced the biggest one-day point drop ever, 1,190 points. As we approach the end of the red February for stocks, the Dow is the weakest of the three major indices, down almost 9% month to date. Goldman, again, this morning, Jim saying they don't think this is over and that buying the dip is, in their words, riskier this time.
Well, there's no doubt about it that there's a part of the S&P and it's very good to look at individual stocks here that are just not viable. And I think that anything that's involved with travel, leisure, autos slowing down, housing, because housing's slowing down. And I don't think if the Fed cut rates, it would matter. But we do need to talk about something that Lee Cooperman and I have always talked about, which is that the algos are in charge. I mean, I noticed this morning at 3. What am I doing up at 3? The bond interest rates were way down, and the futures were, of course, way down. And is that what people should be reacting to at 3? And the answer is, yeah. I mean, these guys are around the clock. They don't make any sense to me. They trade almost methodically. It's the opposite of what we heard Warren Buffett on Monday. I want to go against them. I want to pick stocks. Last night I had a list of stocks that do very well when you stay at home. They should be bought.
You've got a basket of pandemic stocks. You rolled it out last night.
I mean, you look at a Zoom video, okay, and that's Eric Yuan. His company is set up so you can work at home. Ring Central, set up so you can work at home. I mean, Teladoc, set up so you can use it at home. Etsy, so you can make it at home. Square is at home. Trade Desk is what you watch when you cord cut at home. You don't watch, unless it's like March Madness, you don't watch it on TV at the office. Shopify is what you buy and make at home. So I don't know whether you sell Etsy, buy and make at home, all remote, but the futures will sell them because we are decoupling from what the market has been like for a long time. And we're going back to the market that Lee and I remember at Goldman Sachs, which is that there's certain stocks that make sense, but they're all going to be taken down by the futures. Trade Desk had such a good number last night. I have to do individual stocks. It's what I do for a living. And these companies are hoping that they're not saying, listen, we want more coronavirus. No one's really in favor of it.
You did the old wig wag.
What's that?
When I was at Goldman Sachs.
Well, it was
a little levity here.
It was I had hair, man.
The old wee wag.
I had hair. Can we just admit? Okay.
I did want to come back to the yields because even though many people would say it's appropriate to have a 10-year yield now that is 1.193, it is still stunning to watch.
Yeah, it is.
By the way, the credit markets, where you always want to take a look, I'm hearing nothing of any great significance. Choppy in terms of buying and selling, perhaps, but new issuance is fine. This is just not an issue.
I'm not hearing that at
markets.
all. I'm not hearing that at all.
Wait, you're hearing it is an issue?
Yes.
Oh, I'm not.
Oil and gas.
All right. All right. Separate.
What are we going to ask?
Well, I mean, highly leveraged small operators with yes,
but they're going to go.
I'm talking more broadly speaking about if you're trying to raise debt for an LBO, if you were trying to, just if you're trading, if you've got current commitments out there, they are going to be met.
Okay.
You're talking about the one part of the world that,
but it's a domino
that is close already, even in a good economy.
Right. But let's take a company like Chesapeake. I mean, Chesapeake is far-ranging. They have a huge amount of pipe. If they file reorganization, they're not going to need the pipe. We're awash in oil. We're awash in natural gas. The last few years have been about building a part of the country with the best employment, the Permian, and we don't need it. So I agree with you that overall credit and balance sheets so much better. And no one wants to admit that those balance sheets are really great.
We're not at the point where that's got to be a concern. It's much more about valuations in the stock market, economic activity, what's going to be impacted, what we don't know, of course, which is so much larger than what we do know in terms of what that's going to end up being here.
What would it matter to you if, let's say, the top 5 natural gas companies file for reorganization? I'm not going to mention their names. That's ridiculous. Would it matter to you?
No, not really.
Really?
I mean, what are the knock-on effects? How large is it? Is it really going to? It's not going to drill a hole in anybody's balance sheet.
Risk. Headline risk.
Here's where it gets interesting now. Our CapEx decisions in focus. Is this journal story about Cisco layoffs something that's going to be a trend?
Cisco needed to lay them off. I mean, Chuck Robbins has had a couple bad quarters. And they've got to be able to, they have to reconfigure. Remember, they're enterprise. And the enterprise strategy for 5G is not till next year. They have very good, by the way, WebEx for working at home, run by Amy Chang. I think that's a good division. But you really want to ask, is it bought at home? Because that's where we're going to work from.
So does that mean that classic consumer staples are no longer defensive?
No, I think that they're okay. I mean, I think that, all right, so my wife yesterday, what does she do? She listens to the CDC, not the president, and goes and gets all the things she needs. And I come home and piled high on my counter are all the things that the CDC recommends. And when you look at other than Ben Kaiser,
yeah.
Okay? Ben Kaiser,
yeah.
They're all the things that you want. Campbell Soup, Kellogg.
Yeah.
These matter.
Non-perishables.
Non-perishables. So I think non-perishables are great.
People are filling up the pantry. That's
well, how can you not when the CDC on their website?
Right.
I mean, the president may be able to be at odds with some of the people who are at CDC and put Vice President Pence involved, but the CDC page, which tells you what to do, I'm just following them.
I understand.
And that's
can I come back to oil and gas for a second because I think, you're making. They were walking dead, a lot of these names you're talking about already, Jim. It was just a matter of what might knock them off entirely.
Well, if you shoot them right in the head, shoot them in the head, David, right here,
right?
With the arrow, if you have or you're probably not familiar with the actual show.
I did watch, strangely, I did watch many of the shows a year and a half ago when we were in Japan.
Well, remember when they kept trying to get
hotel room for some reason?
They kept trying to get to the CDC.
Watch on TV.
Do you think they're like the president? They kept trying to get to the CDC, and when they got there was nothing.
No, my point is that the headline risk of producers that we've never heard of down in the Permian or somewhere else going bankrupt is not that significant.
Okay,
because
I'm going to agree with him.
Been stress companies for quite some time.
I'm going to go with you. I don't know why. I kind of like my theory, but interest rates just went up again. The bonds just went up again. And so interest rates went down.
Yes.
So it does make me feel like, okay, there's so many other issues. Balance sheet. How are the airlines? How's the cruise ships, do they matter to you? I guess they don't matter.
Well, this morning, Deutsche cuts them all to hold.
Yeah.
They do say, even after the declines of the past 10 days, we cannot realistically recommend buying them. We wouldn't sell them. We wouldn't short them. But a multi-year earnings risk is becoming a greger threat.
Yeah, I would sell them.
You would sell them?
Oh, yeah. I mean, a lot of people need cash to be able to buy the good balance sheet companies. Look, there's not going to be a lot of travel and leisure. And, these companies, they have their better balance sheets, but you have to cut numbers. Every time a number's been cut, I keep waiting for a situation where a number's been cut and a stock stops. The numbers are going to be cut. We have, if you look at Stifel today, they're cutting oils dramatically. I was reading that piece about the cruise ships. Not where to go.
You mean the Deutsche?
Yeah.
You've been talking about cruise ships now for about three weeks.
Yeah, and I've saved you a fortune. Okay, I've saved you an absolute fortune. That's my job right now. And when you look at the cruise ships, they don't come out and tell you what the cancellations are, but they're ground zero. And I think that the Japanese cruise ship may have been one of the worst things
we
I've
reports
ever
of another death on that ship today.
Really?
I do want to mention, because there are elements of hope here today. Starbucks' Kevin Johnson tweeted yesterday, 85% open in China.
Well, do you want to, let's take Disney, all right? Numbers are too high because of the theme parks. Bob Iger left.
Tokyo Disney's closed.
Right. Disney Plus, very good. Do you think Disney balance sheet, good, not as good as it used to be?
Fine. Not a concern in any way.
So why would you buy Disney all the way back to where it was before they announced unbelievable numbers? It's 7 points from there.
You're not that far from buying Disney, where they first warned about ESPN back in 2015.
So why not buy it? Why not start a Disney position for your kids? I mean, I've got a 25 and 28. Now, they're not dependents upon me. I think they know I have a show, not quite sure. But I hope that they use their substantial cash position and put it to work.
I mean,
how about a quarter? How about a quarter of their money?
We're right near the levels where they first started warning about ESPN. Remember, August of 15.
If you're watching this show and you're buying, your kid is 2, and you know this is going to pass someday, you buy half of Disney right now at the open, half. And then you let it go for whatever horrible news.
And be prepared for a decline of whatever else comes.
Well, look, we haven't had any world leaders yet succumb. The Iran seems to approach this thing uniquely. What?
Anything we mention now, I get texts from various hedge fund managers telling me the opposite. Yeah.
Really?
40% of the value of Disney is theme parks, which could be closed soon.
Well, all of the Asian parks are closed.
I'm not going to tell you.
That guy spent 40%. Okay, that person thinks the theme parks will never open again. Right. And they are going to be like the Diamond Princess. Maybe tell me he thinks the Diamond Princess.
People want to pile on. There's a lot.
That was not the love boat
out there, man. There is.
No, there is panic. So is panic a good strategy? How about this? Take a quarter of your money and buy some panic. If you have to sell some airlines,
sure.
If you have to sell some travel and leisure, how many things have you canceled?
I haven't canceled anything yet.
Well, you were never going anything because you never do anything. I canceled.
I'm
trip,
supposed to actually
which
travel
I'm angry about.
The next 2 weeks.
And then I thought that the Olympics, I was thinking about taking a week off because my show's not on. And now I'm thinking, I'm not.
You might be here.
Where am I going to go? Right. Where am I going to go? One of my 12 houses, David?
Yeah, I think you're going to start shuttling amongst the different basements in those houses.
Every one of them has to have, you know what they're going to have?
What?
Velveeta. Yeah, because then if it comes through, even, that stuff works well in a coronavirus.
You're ready got your bunker ready, I'm sure.
I do have my bunker ready.
Leisman, of course, has been on Squawk all morning with Kevin Warsh, talking about 100% chance of a March cut, according to futures contracts, and now some news on Bullard. Hey, Steve.
Hey, Carl, St. Louis Fed President Jim Bullard out with comments just now on Fed policy and the coronavirus. Sounding as if he's leaning against any near-term rate cut. Here's a quote: further policy rate cuts are a possibility if a global pandemic actually develops, with health effects approaching the scale of ordinary influenza. But this is not the baseline case at this time. Bullard said the Fed is monitoring the virus, but is in, quote, a good position because of previous rate cuts put in place to cushion the economy against adverse shocks. He said last year's rate cuts still working their way through the U.S. economy. Bullard said he expects China's first quarter growth to be impacted by the virus, but the effects on other countries will be smaller. Now, while Bullard and other officials seem to be leaning against this idea of immediate cuts, futures markets pricing in those cuts much more aggressively. Take a look at this. As Carl said, 100% chance of a 25 basis point cut, but this is new now. A 71% chance that the Fed actually goes 50 at its meeting next month. And then looking ahead, if you take that second cut there, that second cut 60% priced in for April, 59% chance of a third cut in June, 62% chance. Now, this is also new of a fourth cut in December. Now, former Fed Governor Kevin Warsh on Squawk this morning, reiterating his support for coordinated global rate cuts, a position apparently not yet shared by current Fed officials. Carl?
This is a biological crisis. It is not a financial crisis. What has been lacked is coordinated effort and leaders speaking to each other. It's been abysmal. The WHO, which seems to be owned by China, abysmal. I don't care. I don't give a hoot what the Fed does. It's a biological crisis. And that's what you've got. I'm watching what Dr. Fauci says, and they could cut rates to zero, and it doesn't mean a damn. What we need is a vaccine, and we need something to get you out of the hospital. I care more about Gilead than I care about Jay Powell, because that's what it's about. It's biological. And if we just, they could take rates, they could give us each $1,000 from Bloomberg, of course.
You sound just like Steve. Steve this morning said, at what level of interest rate would I be willing, Steve, didn't you? Would be willing to go to a rock concert and risk contagion.
I take my cue on the Fed from Jim a lot because no one has his ear more to the ground and what companies are saying than Jim does. He was early and right on the rate, on the reversal last year. And now that Jim is not out there calling for the Fed to cut rates, that plays very strongly in my view. I will also add to that a lot of people who I talk to, Carl, who would otherwise be on board with the efficacy and the need for a Fed rate cut are leaning against that this time because of this idea. You know, if the problem is people are not going to go to concerts, is there a level of interest rates that would force me, and you know I'm a big music fan, to go to a show if the risk on the backside of that is the coronavirus? Or is there an interest rate that would cause those planes that United just said are not flying to Tokyo to get back on board? So I take my cue from Jim on this not calling for these Fed rate cuts.
Yeah, I don't really care. I mean, I do care. The Chinese, who have been, I think, totally bad actors in this. They're doing something that is really unbelievable, which is they're on live people. They're testing vaccines. You're supposed to do that very slowly because you could kill people. They obviously are in a different kind of situation in a different country. They are not doing any of the things that is protocol in this country.
No, they're not. But the fact is that if you look at their ability to actually mitigate in terms of new infections, they've been successful in part because of some of the things you talk about that we cannot do here or that other democracies
Singapore as well.
And they can't track you with your mobile phone, for example. Come to your workplace.
We're a free society.
We saw where you were. You were with people who might have been infected. Leave work.
Right, and they have hall
we
passes.
Can't do that
we
here.
can't do that. But they are, they're likely to come up with a vaccine instead of 18 months. Remember, you're giving healthy people a disease. That's not what we do in this country. Now, they are giving it to some people who have mild. And then after a few, we don't know how many weeks, not months, they then give them a total blast of coronavirus. We can't do that.
Where are you hearing all this, by the way?
I spend all the time doing this.
Really?
Yeah.
So how confident that's the case?
Oh, yeah.
Okay.
How about Mulvaney's being interviewed at CPAC, and we'll get to Eamon Javers in a moment, but one of the headlines on the tape is that schools may need to be closed.
Right.
Would
Well,
we
there
be,
you go.
would we
That
do
would be
that?
good. That would be a buying opportunity for some because that's not the age group, and maybe it's the professors, the
Is it
doctor.
too late to just
the
restrict
students.
travel from Italy and South Korea and Japan?
No, you got to do
the
that.
same way that we did with China, and conceivably because we are actually still not at any point where we're seeing clusters of the virus.
No, but Dr. Fauci said from the very beginning, our goal is to slow how long it takes for that to happen. He's never said it won't happen. That's what the president, I think, is saying. And I think a lot of people are unnerved between what the CDC is saying and the president saying. And I think that the professionals are CDC. He may think they're worrying, so like put it in a different tone. But I come back and say, look, we are trying to get antivirals, and they're giving people. I'm working on a drug, all right? It's a very benign drug. It's going to help a lot of people. I can't get past in order to get this thing going, and I think it's really well vetted. It's already 7 months behind. These people in China are violating every protocol we have because it's an authoritarian country. To give people these viruses, that's like giving the Tuskegee soldiers syphilis. But in China, they're not caring.
Let's get some more context on what Mulvaney has said this morning. For that, we will turn to Eamon Javers. Eamon, good morning.
Carl, as you mentioned, the acting chief of staff here at the White House has been speaking at the conservative organization CPAC this morning. He was asked, he said, about calming the markets today. And here's what he said.
I got a note today from a reporter saying, what are you going to do today to calm the markets? And I'm like, really, what I might do today to calm the markets is tell people to turn their televisions off for 24 hours.
So that's Mulvaney. Obviously, at CPAC, this is sort of a very conservative organization. That's where you'd be expected to throw some red meat about the media. Mulvaney appears to be doing that there. But he also tried to put all of this in context in terms of other outbreaks that we've seen around the world. Here's what he said on that point.
Is it real? It absolutely is real. There is no question about it. But you saw the president the other day. The flu is real. At any particular time, 20 million people in this country are going to have the flu. The flu kills people. It does. This is not Ebola, okay? And I'll tell you what that means in a sense. It's not SARS. It's not MERS.
So, Carl, what's the White House's message for this morning? Well, I'm not tracking any sort of major announcement designed to calm the markets today from administration officials. We do expect to see Larry Kudlow on television at 10:30 this morning. I'm not expecting to hear from Steven Mnuchin, the Treasury Secretary, for example, this morning in terms of public engagements either. No sense that there's a hidden announcement about to be unveiled here, but there is a sense that we're going to get some more messaging like we just heard from Mick Mulvaney there. That this is a serious issue. They have it under control, but it's not as serious as some of the other things that we've seen around the world in the past. Guys, back over to you.
I mean, what bothers me, this is the kind of thing that really astonishes me. It's 50 million people in the country, not 20. The death rate is a little bit higher. Some people feel the death rate from the flu is 14,000. Absolutely, this is much. It's 10 times more likely to kill the people who are 80, but it does not that much against younger people. It's a more nuanced thing. I think that he should be worried about the commerce issue. When commerce slows, there will be companies that do poorly. Maybe they could benefit from a rate hike. Typically not. A biological crisis that then turns into an economic crisis is what they should do. That's what I would really like to hear from the Treasury Secretary. Really knows business very well, but not just saying, listen, we're monitoring and we're talking to other countries. What I don't understand is why we're not coordinating with other countries.
Right.
Why?
I don't know the answer. There's plenty of questions. People questioning Japan, certainly, and their protocol or lack thereof in terms of letting a lot of people walk around conceivably who were on the cruise, who had the virus, and so things. Jim, I wonder, to the extent that this administration for the last 3 years has made the stock market, in some ways, its key report card and a reflection of success, something the president has come back to time and again. Is there a concern, because I've heard it, that their unwillingness to potentially do something or announce something that would hurt the stock market, even though it might be the right thing to do, will get in the way here?
Yes, I'm concerned about that. Again, just have the pros. There's pros. We have the really great CDC. But just say, listen, we're going to listen to the pros, try to get them measured, don't have them. Dr. Fauci's been measured the whole time. Right. Remember, he's the man who got AIDS. He got AIDS fixed.
No, he's measured and reassuring at the same time.
Right.
And yet not saying anything that is...
Do you believe the Times piece that he's been asked to clear his comments with the White House before saying them?
He's a courageous man who will do what's right for the country. And that's all I know. Whether it means violating what Vice President Pence says or not, he's a courageous man. He's a doctor. He wants to help people. I do think that there are countries, by the way, in terms of our rate cut, not as important, there are countries doing very poorly. And they should be doing a little fiscal spend. Germany, this is their chance. China should sell it. China has, what 1.1 trillion in treasuries? Why are they not repatriating that? Look at the
they're up on it, right? They're doing great. Yeah.
Well, they ought to ring the register. They're being foolish, but they've been foolish the whole way because it turns out that they are a second-rate communist regime.
You really do like to.
I've been right the whole time about this paper tiger,
don't you? Yeah.
They're a paper tiger. Well, it turns out they're
really about it right now.
How about the 50 million people are in the cordon? What's happening in the cordon?
The South China Morning Post this morning, I think we still have Eamon, by the way, has a piece out this morning that China may invoke force majeure on phase one. There's something we haven't talked about, Eamon, for a couple of weeks.
Yeah, administration officials have said that they believe that the Chinese will hold to phase one and that they haven't heard any different. So we'll see if that changes during the course of the day today. And then to respond to David's question about the administration and markets, I think you really need to look at what the president is saying here. He said this again last night. He's asked about this massive sell-off we've seen on Wall Street so far this week. The number one reason for that he cites, he said it to me on Wednesday and he said it again last night, is he believes this is driven by the Democratic presidential debates, right? That is the first reason he cites. He does say that the virus is playing a role here, but he says that second. Each time he's asked about this over the past 48 hours, he's cited Democrats and Bernie Sanders, not necessarily the virus, as his first response. So I think that's where the White House is looking right now. And that, everything flows from the top in this White House as in any. And so I think you have to look at that to understand where the administration's head is right now on this.
Yeah, I'm not hearing that from many market participants. Right. Not that it isn't something that is part of the mix at this point, where the idea, again, the lack of any clarity in terms of the virus and what it will do and how disruptive it will be. But if, in fact, it were to extend through the summer or into the fall and election season, does that raise the possibility and an economic slowdown of significance that Bernie Sanders, were he the nominee, could actually win? Or who knows? Is figuring into people's thinking. However, I think they're much more focused.
No, I think it's
part
of the decline. But let's go back to what Lee Cooperman said. It's happening very fast, and a lot of that is just interest rates down. Well, that means we must sell in the futures, and so we can talk about where stocks could be, but these people do. There's no uptick rule, and these people go to work like they did in 2008, and that creates a nothing to fear but fear itself. This is an illness. It will pass. We have no recorded instances of coronaviruses, of which this is one, where you get it and then it goes away and then you get it again. But
in this country.
In our country, we lack the clarity of what the Chinese are doing. We should be on the phone to the Chinese every day, talking to them. We have to figure out why WHO, has really been negligent. Why have they dropped the ball? And I think the answer is that they've somehow become captive to China. They're a little embarrassing.
Their rhetoric has been slow to ramp up, there's no doubt.
But they used to be a very interesting, very good organization, and I'm really ashamed of what they're doing. I think the CDC's been good. I really hope the president backs off a little.
Sure. The airlines, meantime, continue to cut capacity. Phil LeBeau had that headline earlier this morning and joins us again. Morning, Phil.
Hey, Carl, I know we have the opening bell in a couple of minutes. Let me quickly run down some of the news this morning. United Airlines out with a reduction in its schedule for Japan, Singapore, South Korea. No surprise because of a drop-off in demand. It's also extending how long it will not be flying into China from its hubs here in the U.S., now going out to April 30th. When you look at the airline stocks, they're all expected to open up anywhere between 3 and 4% lower this morning. It brings up the question, and Jim, you touched on this on your show last night, where's the floor here? These may be well-run companies. Southwest Airlines, a good example. But Hunter Kay with Wolf Research, one of the really bright analysts when it comes to airlines out on the street right now, he has a note this morning. He says, it is difficult to find a floor for these stocks on a valuation basis. And that's where we are with the airlines right now, guys, as they bring down their schedules for Asia Pacific and China already cut completely. Do they start doing that for transatlantic routes? That's going to be the focus over the next few days.
Phil, thank you. Jim, to Phil's point, in the past couple of days, Nestle restricting international travel. Yeah. Now it's JP Morgan. The Geneva Motor Show has been canceled. Microsoft canceling participation in a gaming conference.
I think those stocks should be sold if you need money. I think a lot of people are full up. They own a lot of stocks. Those are sources of fund even down here because they're in what I call the blast zone. If they're down 2 to 3%, that's an interesting opportunity to sell them because there's going to be so many other things. I mean, if I can get Microsoft at 125, I better have the cash. And if the cash means I have to sell a fine company like Southwest Air, which is still up a lot from where it was when the president was elected, I would sell Southwest Air. That's an interesting opportunity to raise capital. This is very much at odds with Buffett on Monday. Why? He has a lot of cash. I think many of our viewers are full up. They've owned stocks. So they need to make those sales to be able to buy really high quality, great balance sheet companies where if things do worsen on Monday, Tuesday, and we can come in and someone notable, say, has the virus, which is going to scare people.
But for someone who advises viewers often not to trade things quickly, this is a sign that you think we're going to be living with it for a while.
Yeah, well, I just think that there's so many people that don't have the capital to buy ATT at 32, which is such a buy versus treasuries, particularly because things are buy road and treasuries. I want them to have the capital to do that. I would much rather have ATT at 32 and sell some Southwest. And just because, only because people, if you have cash, don't listen to this. You're fine. Then you're Warren Buffett. But if you don't have cash, I want you to be able to buy higher quality stocks. If you're in an oil stock, if you're an Exxon, geez, would you rather buy Apple at 210 or Exxon at 45?
Well, according to you should not buy Exxon at any price.
Not at all. Not at all. Not at all.
Let's get the opening bell here. It's good to hear some applause on this Friday morning as we close out what's obviously been a brutal week. At the big board, celebrating its recent listing, it's Vertiv, a data center infrastructure, equipment, and services vendor. At the NASDAQ, it's TechStream, a human delivery and healthcare platform. All right, so we're going to watch support. Jim, just yesterday, Goldman said 2,900, and we're going to open really right there, right below it.
I just put some, it could be foolish, but I have had 401k money on the sideline. I am trying to get, while I'm on, just before I was on, of course, to find out what I have so I can put a quarter of my 401k over the day, 1 quarter. Therefore, I'm expecting that things could be worse Monday. But what am I going to do? We had 10 to 1 negative. We're going to have 10 to 1 negative again. If Mark Haynes were sitting here, he would say that's extreme. The late Mark Haynes, I think, had a very good handle. But I don't have much choice. I think that those of us who have waited and waited and waited, we have no choice but to buy something. We don't have a choice. What are we waiting for? A bounce? You don't buy the bounce. You put some money here.
What about the names? There's a piece on the tape today about Clorox. The lead is bleach kills 99.9% of germs. Right now, it's beating 99.9% of stocks. You chase it?
My charitable trust has a substantial position in Clorox. When we met this morning, I said sell it.
Sell Clorox.
Sell the whole darn thing. It's up so much. But it's restricted because we mentioned it. But, we were fortunate. Ben O'Dwyer was on the show. They have products. I covered when I used to cover homicide, I covered a train wreck. Chlorine gas. 5 people died instantaneously. Nothing lives through chlorine. Nothing. And that's because it chokes off any oxygen. But what the heck am I doing with that gate? That's foolhardy. So, yes, I wanted to sell it. Now, I can't. I'm a buyer here, not a seller, unless it's up so much like Clorox that I'm just not playing with the house's money. Come on. Sell Clorox and buy some NVIDIA if you want, for heaven's sake.
Well, not easy to find anything in the green this morning.
Isn't that an opportunity? Well, what a great thing.
1.9%. 9.5% now is the loss for the year. This, of course, a huge reversal just from where we were a couple of weeks ago.
Well, it's probably not low enough to...
Long it up 4 or 5% on the year.
Remember, SARS, 14%. More lethal, but obviously fewer people didn't catch it. So if you want to use SARS as a good example, then you probably want to buy some. SARS was a V-shaped recovery. We don't know who has a vaccine going on right now.
Netflix in your stay-at-home portfolio?
I debated putting Netflix in my stay-at-home portfolio.
Well,
it's very interesting you say that. Yeah. But I went with Trade Desk because they had just reported a good quarter.
So MKM had a similar basket, a little broader. They added Yelp, Activision.
No one's even...
They added Blue Apron.
Blue Apron. There's a name I haven't heard.
Okay, I am Jimmy Chill. I will not comment on those other than say Blue Apron hope to stay in business. I own a restaurant. Yelp? I mean, Yelp? I mean, we're not even making the playoffs here. Yelp is about going out. It's not about staying. What are you, like, rating your couch? Hey, you know, my couch is 4 stars. Oh, really? My chair is 5 stars.
I'll tell you what, Netflix is up 1%, right?
Well, Netflix
of the
makes
5
sense.
S&Pers that are green.
Netflix makes sense, and I think that some of the programs, right? Like I do want to watch that one from South Korea. Look what they did at AMC. They cut the dividend in order to be able to buy back stock. That is a bold move. I don't want to buy that because I don't want to go to the movies. But Netflix is a good bet to stay at home.
AMC's in a tough
Zoom, yeah, they are. Balance sheet.
Yeah,
Zoom
balance
is,
sheet and
remember,
a lack of
Live Nation's down 20% in 10 days.
He's a good guy, but that's obviously the wrong stock to buy. Zoom is based on the idea that you work at home. So even though it's up a lot, Eric Yuan, when he came on Mad Money, he said, listen, the phone is ringing off the hook. Now, that's a highly unusual thing. Trade Desk quarter was remarkable. Remember what Trade Desk is about? Staying at home and cutting the cord. Those are two very large scenarios. What are the hospitals going to say? They're going to say, could you get Teladoc first before you come in? Because we really don't want you to come into the hospital because it's a bad place to be. Shopify is...
No, I get it.
Shopify is at-home crafts sold. What? I think these are
even if, as we all hope, we avert the worst or even close to it, people are still going to be encouraged to stay home if they have any symptoms or even if they've returned from a vacation somewhere where they were.
The whole idea of going to work when you're even a little bit sick is over. No one wants you there. No one's going to want to see you.
No, and we need a memo. All companies need a memo saying that we will fire you if you come to work and we know you're sick, because those are people who are doing us no favors. Now, the Harvard School of Public Health, the most bearish person there says 60% of us will get it. Now, 60% is quite a few people. And there again, that's why I say the Fed, 60%, let's not worry. But other countries really have to start stepping up so their businesses don't go out of business. I don't want VW to be in trouble because the Germans continue to hoard their cash. I want the Chinese to sell their treasuries. And I want Steve Mnuchin to have a behind-the-scenes conference call and then come out and say, listen, other countries are doing the right thing. And if they're not, we're going to urge them to. And I think that we do have to worry about the businesses of other countries. Are you not worried about like a buyer?
No, listen, a lot of this is a result of concerns about slowdowns in economic activity in other countries, starting, of course, with China, which, by the way, we still don't know exactly what the damage has been there.
But they have $1 trillion in treasuries. What are they doing? They have an unbelievable win. Are they not savvy at all? I keep hearing about all these institutions. I mean, look, let's talk about what I regard. I would have used phony at one time if I had not become Jimmy Chill. The idea that the Chinese stock market has barely lost anything. But
shares were up for the week yesterday.
I believe that from what I can tell, my stepson is a great Chinese scholar. He says, you have to register with the government to sell. Now, what is that call like? Hey, I got to blow out of a lot of Baidu. Well, I'll blow your head off if you buy a lot of Baidu. Man, well, that's metaphorically speaking. I don't think you can. The Chinese stock market, this is the time when it's clearly rigged, and the MSCI and Henry Fernandez, who runs that great company, has to call them and say, guys, this is not a real market. Now, I'm just probably reluctant to do it, and I don't blame them. China's a big country, but the Chinese, tell me how they've distinguished themselves other than put a Leningrad-like cordon around 50 million people. Leningrad only 2 million, then dropping to quite a bit. And I never like to conflate that country and what happened in that war, but I've never seen anything like it where you literally can't get out of an area where you know you're going to get sick. That's a remarkable thing. It sacrificed them in order to be able to make it so Hewlett Packard's able to make PCs. I think that's remarkable. But I reiterate that I'm a buyer, not a seller.
Right.
Because of the extreme oversold nature. And I do believe that you have to have a leader get sick on Monday or Tuesday to make it so we go down substantially.
I mean, the reversal, though, has been extraordinary. When I look at Apple down 10% for the year and can remember, it feels like just a few trading days ago, it was up double digits for the year. That said, it's only back to where it was in November.
David, that's the problem. That's why I said,
broadly speaking, the market's only back to sort of October.
But remember, they've gone service revenue, but
we have given up economic gains that were potentially forecast in October when we were less.
Okay, how about this? You want to buy 100 shares of Apple? I'm talking about a Robinhood-like customer. I would buy 25. Right here. I'm a buyer of Apple, not a seller.
Okay.
Great balance sheet, doing quite well. And you know what? Here's my reason. Because there isn't any person in public health who says this won't end at a certain point. So do I have to wait till the day that Dr. Fauci says, you know what? I think we've got, or the Israelis, we've got the vaccine, or that a Moderna in China, they're willing to risk killing people, obviously, to find out if it works. The Gilead, they're letting double down on. I mean, we have very smart people. Obviously, I'd like to see $100 million prize for someone who comes up like Dr. Solov with polio.
There's the creation of that, and then you were the first to raise the idea of drug shortages earlier in the week. Mylan's the number one loser today.
Let's
Jim.
going over where we've allowed China to make both the ingredients, the actual pills. It's quite frightening. There I am frightened. There's going to be some testimony on the Hill. I went to Duane Reade yesterday to get 2 months worth of drugs that I need. And United Health has not approved that yet. That level of irresponsibility is shocking to me. I mean, there's CDC's asking you to get the medicines you need. So that industry has to get its act together. If they're really thinking about money right now, then Bernie Sanders is going to win. They better take a little longer-term view.
It's a big hill to climb to move that supply chain.
The point is, I'm not going to mention the drugs, but let me tell you, I don't know whether they don't have them because of the Chinese or because the drug companies are being controlled by these health organizations that really have to change their way. I'm urging right now, every health insurer should give people 2 months of drugs so they don't have to go out. I'm also, again, insisting that people who have not bought anything, take a shot. And take a shot is too metaphorical, I know. But
well, we're coming off, for now, at least the lows. Chris, we've only been open about 10 minutes.
David, let me give you an idea.
The S&P is off the lows.
But let me give you an idea, David.
Yes,
There's a company called TJX. It just reported a remarkable quarter, truly remarkable. And David, after this show, we'll go next door to TJX. I'll get you a real shirt and tie.
I prefer you didn't.
But
TJX.
Okay, so what is no? Let me go wide TJX. What kind of merchandise do they have?
Actually, good merchandise.
And where did it come from?
It came from high-end places.
It came from people who were levered up and needed to get rid of it.
Had to get rid of it. Yeah.
So TJX, I will go as low as Ollie's. I didn't want to do that because Mark Butler passed away. It was a tremendous philanthropic man. But I do believe that you have to start thinking about places like a TJX where they have the inventory from companies that may not make it. There are some very bad balance sheet companies in retail.
Yes. I think that goes without saying.
Now, let's take VMware versus Workday. VMware, not a great quarter, candidly, just not great. Workday, really good quarter, but not able to have their big sales meeting. With internal sales meeting. But I like Workday. They're winning a lot of business. Don't forget, remember Salesforce where Mark Benioff said they've been relatively, not bad. Now, I know Keith Block left, and I happen to like Keith Block very much other than the fact that he's a Patriot fan. But here we have a stock at 168 that was at 195 7 days ago, 10 days ago. That's very intriguing to me.
What do you make of some of the value hunting going on right now? Among the names that are up, Hilton, Tiffany, Viacom, CBS, and Carnival, all in the green this morning.
Well, my charitable trust owns CVS and Viacom. Viacom is uniquely horrible, but we did think about buying it because it's at a certain point, because it bounced yesterday. At one point, it was up 2%. CVS is now down 17 straight points. They had a very good quarter. Some people may be concerned about their balance sheet. Hilton is ill-advised, and the people who are buying Hilton, I hope they're working on a cure, because you're going to need it.
Viacom discovering Netflix all up. Viacom's basically lost one of the other. It lost the entire market cap of
Why
itself.
is that, David? Do you think that's management, or do you think it's pixie dust?
I think it's concern.
Concern what? Balance
the
sheet?
ability of the company to grow.
By Trade Desk.
And to succeed.
I actually bought, my charitable trust bought it. Let's go over why my charitable trust bought it.
Continues
I listened to management. And you know what, David?
From what company was this?
Viacom.
Oh.
A wise man once told me, sometimes you just get had.
Yeah, you've made it more than clear.
Yes.
Right.
About how you feel.
Or you could be very much like Andy Dufresne. I'm the warden. and he's just told me how obtuse I am.
Yes. Don't call me obtuse, whatever that means. Talking management, I want to talk a little about HP and Xerox.
Yes, please.
But we can't now, though, because
why not?
Because we're going to be getting to Rick Santelli for Chicago PMI in a moment.
David, it's a big.
We want to hit that. So think about it. We'll take a look.
Wait, just think about it and
are down, and let's go to Rick.
Let me do some telepathy. Let's go.
Live long and prosper?
Yes.
All right.
Exactly. It's good measure.
Yeah,
it's something.
I think great advice.
Theme. It's a theme.
We are going to get Chicago PMI in a couple of moments. That's going to be a number. The CME. Good morning, Rick.
Good morning, Carl. And before we get to that, let's look at some charts. If you look at these levels since November of 2016. If you open it up to October, you can see what I'm talking about. Look at a 1 week of 10. This is unbelievable, the types of drops we've seen from close to 150 to now hovering below 120. A breathtaking move, a date with history. And if we look at Boone deals, currently at minus 62, open that chart and you can see minus 71 is the all-time low closing yield. And even though they have moved more slowly down, they've still reacted as a sovereign safe harbor, but the spread has narrowed rather dramatically to treasuries. And in many ways, that has fueled what's going on with regard to the euro currency. Now, whether it's rebalancing of dollar longs, this week has not been a very good week for the dollar, but it's been a huge up week for the euro currency and the yield curve, which now currently at 26 basis points is the steepest it's been since mid-January. And in terms of Chicago PMI, of course, this February read will be important to see how the economy, at least from the vantage point of Chicago, was faring before coronavirus. 49.0 is our read on February. It's 3 points better than expected. And in the rearview mirror, we're leaving a very nasty 42.9. That was the lowest read since the end of 2015. So we do move higher. Now the whole game is how much different will the U.S. economy be during and post-coronavirus than it was before it settled in? And that isn't an easy question to answer. The market certainly assumed the worst based on outside forces, but when the data points start to hit in 3 to 6 weeks, of course, we'll know better. Back to David, Carl, and Jim.
All right. Rick, thank you. I'll take it.
What'd you got there?
Let's talk a little HP quickly. A specific news story here, of course, a battle we've been following since it first became public, or even before when we kind of made some parts of it public. We got a background to the solicitation, is what they're calling it, from HP last night. This involves their wanting to put out everything that went on between them and Xerox, both that we know about because it was in the public realm, but also prior to that offer that was made by Xerox. They put it out now because Xerox itself is expected to come very soon with its exchange offer, and so you'd need that from HP. Mm-hmm. And Jim, what they've done here is really just taken a knife, and I don't know how you want to describe it. They've just come right at them with both guns blaring. I use whatever analogies you want to use. It's just basically saying, you guys are not serious. And I'll refer to a couple of the different things that are in here, and differ in part from what we've heard from Xerox in terms of their interpretation as to the back and forth between the two companies, again, before Xerox made its public offer, and Mr. Icahn, his role here, which is made out certainly in the early days of August and even in the summer of 2018 to have been a fairly significant one. Mm-hmm. September 4th, I'll refer you to, though. They say Mr. Byzantine stated, and he is the CEO of Xerox, and this was a meeting with him and Dion Weisler.
Was Weisler, or was it with Chip Berg?
No.
Chip Berg and...
No Chip Berg. There was no Chip Berg meeting referred to at all in here.
Okay, so this when Dion was still CEO?
Yes. Strategically, Xerox's board believes Xerox was out of organic growth opportunities and must either grow through a strategic acquisition or be acquired. This is, again, is what they're saying Byzantine said. And that Xerox could try to acquire HP, but the extreme leverage, all the debt they need to take on to make an acquisition, the resulting would, of course, resulting potential for a credit downgrade, make it preferable for HP to buy Xerox. And so you buy us. And again, they always come back to the big synergies. Icon had been touting, again, according to this background, as much as $3.5 billion in synergies and cost savings and just efficiencies they'd be able to have if Byzantine ran the combined company. HP keeps coming back on that in a big way, saying that is not the case, and that HP could not specify a price to buy Xerox, even though they looked like they wanted 42 to 46, without this information. Threshold information is what they call it. And they say on October 10th, Xerox was unwilling to provide any substantive information without an offer that was indicative from HP. That's where things stood. Then Xerox
That's not
made their move.
That's not what Enrique Laura said to me on Mad Money. He said they're happy to talk.
Well, they are going to potentially talk.
Okay.
But one side sees $1 billion in synergies. The other sees $2 billion that they want to put out there publicly, but a lot more privately. And so the question is how they could ever really come to any sort of agreement. This will go to shareholders, it seems, more likely than not.
Why are they
and it will
doing
be up
this?
to the shareholders to make a decision.
We have an
as to whether
economic.
they believe Xerox
Look, when they started,
their ability to deliver synergies, Byzantine running it, is superior to the value that Mr. Lohr.
When they started this, it was before the biological crisis.
Yeah.
How irresponsible is Xerox? They're kind of shameful at this point. And by the way, Enrique. I'm not kidding. How could they not reevaluate and say, you know what? In light of this, we're going to be taking down too much debt, and we're going to be doubling down on it. So we're going to wait. That's what you do.
You don't. By the way, merger agreements from here, not that has to do with this, are going to be carving out coronavirus for
They're
sure.
Comical.
That's
Banker Goldman? Xerox?
No, HP's Banker's Goldman.
No, okay, so HP is doing the right thing, and Xerox is kind of embarrassed.
Well, you've been saying that all along.
Well, I mean, it was Xerox since the old days, in the 1980s, when I actually covered the company. You know, it's been a failed company for a long time. They did sell stuff, but you want to be irresponsible. We're going to look back in that era and say, you know what, that was Snapple.
We'll see. Carl, I know we got to get to Bob.
It was Monsanto.
Watching 2,900 here, guys, and the VIX still at 42. Let's get to Bob Pisani.
Nice.
Bob.
Down 11 on Apple. So we're off the lows, but not convincingly. So Boeing's down 7, JP Morgan down 4. Just want to show you the sectors here because they're all down 12% from their highs recently. Banks is a new low for the KBE. Semis hitting very hard. They're worse, down 17% from their highs. But look, utilities, 12% off of their recent highs. REITs, 12% off their recent highs. Consumer staples, 12% off their highs. This is what I call the global takedown of the entire stock market system. Take a look at the capitalization in the United States. There are a lot of questions about how much a haircut we've taken, but here you see the open right here around Europe. Lows there. This has happened a lot this week. Obviously, a lot of selling going on in Europe, but we improve a little bit, and you can see near the lows for the day. Back market capitalizations, U.S. stock market capitalization. Guess what? It's down about 12%. The whole thing here. U.S. values, $33 trillion. That's the U.S. stock market valuation. Now 29. That's down 4 trillion. That's about 12% decline. Very similar in the global stock market. The U.S. stock market is about half of all the value of the global stock market. 60 trillion is the global value of the stock market. It, too, has dropped about 10%. This is since the February 19th high, and this includes the entire global stock market. So a real haircut. And what's remarkable is to look at the numbers. Everything is the same, essentially. This is what I talk about the global's takedown. Just take a look at the next number. Hong Kong, Europe, Shanghai, Japan, United States, everything down 12, 13, 14%, lowering the risk overall, the entire environment. Finally, I just want to point out something. A lot of stress this week. A lot of people, same side of the trade. Everybody's been wanting to sell. How has the market structure hold up in the United States? I think pretty well. I didn't see any circuit breakers hit. Individual stock circuit breakers, there were a few, but not that many. I did not hear of any notable tape delays. I did not hear of any breakdowns. Remember, enormous stress, volumes much heavier than normal. I also did not hear of any big ETF issues. Remember a couple years ago, big issues around the volatility ETFs. Didn't hear of any of that either. Now, this is not a complete review. We've got another day to go through, but overall, systems held up pretty well. I do want to note, NYSE sent out a notice yesterday that they were going to have this disaster recovery testing that would be done in March, but that's pretty standard procedure. Guys, back to you.
You just, Bob, the great report, but I want to point out that what you just tweeted, that AMLO, President of Mexico, daily, I think that's very wise. I think that he's a steady hand.
Yep. News conference tonight, 9 o'clock after the first.
Just a steady hand. We want to hear from him. If you were from Mexico, I do a lot of business in Mexico. It's very reassuring because he's just saying, look, I'm going to come on every night because I think that it's important to show my face.
Right. He does a morning briefing every day?
I like him very much. I think he's trying. Obviously, the cartel's so tough.
3M's the only Dow stock that's higher as the outbreak widens. A shortage of respirator face masks has sparked a global race to fulfill those orders. 3M is in the mix, and Seema Modi is inside.
4-day wait to get them, okay? And by the way, you're buying them third party, not from 3M.
It's good information. Seema Modi is inside the manufacturing plant in Aberdeen, South Dakota. Hi, Seema.
Hey, Carl, fast-tracking production of the N95 respirator is no easy task, and that's why 3M is ramping up hiring, hosting job fairs, and making offers on the spot here at one of its largest manufacturing facilities in Aberdeen, South Dakota. More than 650 employees are working additional hours, and 3M says they're also adding more assembly lines to meet the surge in demand for these face masks.
We immediately ramped up production in this facility. We have capacity to do that, and we've done that immediately. Really from more of a standard 5-day week to more of a 7-day week, with additional equipment as well that we've been able to bring in and turn on.
Now, part of the reason there's a shortage in supply of these respirators is the industry's over-reliance on China over the past couple of years. The other thing to keep in mind, the Department of Human Health and Services saying 60% of large-scale pharmacies are currently sold out of these respirators. You go online, whether it's Amazon or Alibaba, you can't get these face masks that are in such high demand. And with no vaccine on the market, experts say medical workers really have to rely on this protective gear to stay safe and to protect themselves from infection. Now, it's not just 3M that is really ramping up production. Other manufacturers, Kimberly-Clark, Honeywell, are also trying to meet this really high demand for these face masks. And of course, in a way, their output plays a big role in the speed at which this virus can spread, guys. Back to you.
All right, Seema, we'll be checking in with you all morning long. Jim, I mean, from a practical standpoint, should people struggle? Should they fight to get their hands on one of these?
Yes, yeah. I think so. Remember, there's two kinds of... you can have the masks that are... Those masks, 3M masks, are capable of stopping small molecules, which is what this is, unfortunately. The other kinds of masks are very good if you have it and don't want to give it to others. The respirator, the Honeywell, is $5,000, and it's that's the one that is used on a job site. I would not recommend people buy that because that's on the Amazon one. The other ones I think are good, but obviously not. They're enterprise, not individual. And let's not be ridiculous. Should we all walk around with a 3M? I'm debating that if we have a pandemic that actually strikes here.
Well, Amazon told NBC this morning they've removed 1 million products on their website for faulty claims about protecting you from the virus.
Only the 3M has been shown. Now, 3M has many other businesses. It's a bit like Clorox. You don't want to own 3M for the mask. That would be foolhardy. Do you want to buy the mask? You can go on Amazon. It's third party. Remember, you're not buying it from 3M. I'd like to think that they're pretty responsible and vetted at Amazon, but very orderly if you want to get it. And I personally understand why you would want to.
Jim, tonight on Mad?
Yeah, I've got Alan McKim who will be able to give us the state of oil, which, I think is just completely abysmal. It should not be bought. Hannon Armstrong about ESG, about just kind of climate change too. I'll go for it. Atlassian. What is Atlassian? Well, stay at home. It's stay at home and fabulous. And therefore, I think it's really good.
Soon enough, there'll be a stay-at-home ETF.
I created this morning with my staff.
Yeah.
I won't get any credit for it. Someone will steal it, and like they stole Fang.
Bunker.
Yeah.
Bunker. Chef Boyardee.
Jim, we'll see you tonight. Our thanks to you, as always, for helping us understand this week.
We have to just relax. I mean, you buy a little. I don't think it'll be up today, but you buy a little.
Dow down 850 almost, 10-year 117. Back in a minute.
The Bond Report is sponsored by PIMCO.
Don't get mad. Get E-Trade, dog.
This is the first day of my life. I swear I was born right in the doorway. Now I don't know where I am, I don't know where I've been, but I know where I wanna go.
Apps are used everywhere except work. Why is that? Is it because people love filling out forms? Maybe they like checking with their supervisor to see how much vacation time they have. Or sending corporate their expense reports. I'll let you in on a little secret. They don't. By empowering employees to manage their own tasks, Paycom frees you to focus on the business of business. To learn more, visit paycom.com.
You met on an app. Delete it.
Why?
He's the one. Gesundheit. I see something else. A star with 3 points. You're in a Mercedes.
Yeah, we wish.
Wish granted. With 4 models starting under $37,000, there could be